We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted last week. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app because then you can actually log in and ask us questions and interact with us as well. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, and anywhere you want to listen to it, as well as Odysee if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
Hey, Tom.
Hey, Bob. Thanks for joining me.
Yeah.
Hey, Bob. Did you want to start chatting about these Barclays ETNs that got suspended?
Yeah, we could jump on that. I guess with regard to the market action this past week, and it was kind of odd. These Barclays ETNs, even though these have the word silver and gold in them or commodities in them, they're really more predicated on futures contracts and sort of the rolling provision where it actually has nothing to do with the actual underlying commodity. It's more on the the derivative side. And from what I read and what I understood was that basically in March, I think it was March, they sold, I guess, $15 billion more in securities than they actually had authorized, I guess, shares to take in. So they oversold or sold unregistered securities, and that forced them to basically close those programs down, I guess, halt them until they could actually get authorized shares created, I guess. And that may have froze the futures markets or put pressure on the futures markets for unwinding. And then if these, as we were kind of approaching a delivery month, or rolling the contracts forward, they may not have had the order flow. So it may have been closing out contracts only that may have been bought, but not rolling as many or buying the next futures or the next month on the roll. So it could have put sort of undue pressure on the markets here artificially.
So, Bob, what's the difference between, let's say, an ETF and an ETN?
The ETNs, I believe, are more, those are more notes. So when you see, I kind of wrote about that on Twitter. These are basically unsecured loans, I guess you could say. Basically, you can lose everything in these ETNs. It's a dead instrument. Versus like an ETF where it's more of an equity instrument that's predicated on the idea that it has some type of underlying instrument to it. Like if it's SLV, for example, it may have physical metal. So that's the primary difference, if that kind of helps.
Yeah, it's to be honest, I've never looked at these before, so I would have to do a bit more research to kind of familiarize myself. But yeah, it's kind of funny. They all look commodity related, and that's quite the list of total ETNs that they suspended.
Right. Well, it's just like I did a tweet earlier this week, or maybe it was last week, on like that DB Silver Fund, for example, where some of these other ETFs, where people, if they're not really watching the market or watching what they're buying, and they're just buying, oh, it's a silver fund, I'll just go ahead and buy silver because I'm bullish on it. And it turns out the fund actually, all they do is they have treasury securities that are collateralized to buy futures contracts, but they use the word silver in the fund. This is typical Wall Street sort of product that's put out into the market. And of course, we kind of mentioned this, I think, in a previous spaces with regard to Bank of America and their derivative structure, and how they've created some of these kind of crazy products, I guess you could say. I know I keep kind of mentioning them, but see if I could pull up one of those. Yeah, it's like, like JP Morgan, the uncapped contingent buffered return enhanced notes linked to the lesser performing of the Spiders Gold Trust or the iShares Silver Trust. These products are more designed for institutions that say, for example, they want some type of commodity exposure, but they actually don't want to have the commodity at all. They kind of use some type of derivative product that's created that gives them some type of exposure to some degree, I guess you could call it, because it really doesn't have any linkage to the actual metal or directly to the actual metal. It's more of a derivative of a derivative, kind of like a CDO squared, I guess you could say, with regard to, like in The Big Short, people betting on the person betting on who has the blackjack hand, I guess.
Right. Okay. And then I think one of the other things we wanted to cover too or that we were kind of talking about, was if that the metal or the nickel squeeze that we saw on the LME, if that could happen in gold and silver.
Yeah, that's an interesting thing. I kind of put together a sort of a tweet or a thread earlier this week, I think it was, with regard to what I've kind of uncovered with Chinese bars and Russian bars and so forth. And because we actually had a situation where we were trying to bring some good delivery bars into the country, and we happened to stumble across this. In fact, I talked to the CME about this, and I think it was Market Surveillance I talked to. They didn't even know about this, and they ended up having to get back to me and said that the only time they'd ever heard of someone trying to redeliver or deliver good delivery Chinese bars onto the COMEX was, I think last year it was tried, but someone had run into an issue but it wasn't really followed up. So I think I kind of hit upon something that, not that I uncovered, some type of hidden gem, but the idea that these Chinese bars, no matter if they're in London or if they're in Singapore or if they're coming from China or if they're coming from Mexico, if it has the hallmark of China stamped on it or a Chinese refiner stamped on that bar, it's subject to a 25% tariff, no matter where that metal actually is, no matter when it was bought. It could have been bought 10 years ago and held in London, for example. If it's actually attempted to be delivered onto the COMEX to maybe be used as collateral or as a delivery against, say, for example, someone had shorted call options, for example. Kind of similar to like the LME nickel fiasco, where someone had shorted the contract, or for example, may have just shorted call options and tried to collect that premium, and all of a sudden the option starts rising in value. And so basically what happens in that scenario is you can't actually use the underlying metal to deliver against that contract or deliver against that bet, I guess you could say, because to bring that metal into the country would cost you 25% of the entire value of the silver, which no one really, I've never even come across this. It's the first time, in fact, I think one of the persons at Market Surveillance ever even heard about this. So, and I ended up talking to U.S. Customs and Border Patrol. I've talked to Lloyd's of London. I talked to numerous players in the industry, and there's just no way around trying to deliver these bars into the country. Even if they were not held in China, they were actually just simply stored at a neutral vault.
If I can address one thing, and that is the way I understand it in London on the nickel deal was one big producer or one big commercial guy that was short a whole bunch. And I'm not quite sure. I don't really know anything about LME, if they've got position limits or not. COMEX does have position limits. Certainly, there are exclusions for commercials if somebody's hedging. But if they were hedging, that means that they'd have the metal in their vault or in a series of vaults. So I had given Bob kudos on Twitter earlier this week that either he's ahead of the curve or it's an unknown. But it would be my opinion. I have not had anything come across my desk denoting that Chinese silver is available at any place, I guess, at a 25% surcharge or tax. So I would say that position limits on COMEX would prevent the exact same thing happening. The way I understand it is one particular entity or person had a 60 or 70% coverage in London.
Did you guys find that, really digging into some of the details in that story, that it was difficult to kind of separate the hearsay and try to understand the actual story as the facts were, let's say?
Are you talking about the LME story?
Yeah.
From what I kind of gathered, it was basically a producer that had shorted, obviously a lot of nickel. But the nickel market, it's kind of odd. Base metals are a little bit different than gold and silver, for example. Gold, when it's taken out of a mine or sent to a producer or a refiner, it can be overnighted. But when you're dealing with large base metals, those are put on a boat, for example, and shipped across the ocean, and it takes time to get from point A to point B. So in that regard, some of these producers will short their production, but the production may not be in London, for example. It may be on a boat from one continent to another continent. They're just trying to neutralize the price risk. And so some of the LME situation, when that price started to rocket to the upside, the speculators were pushing the price higher. The producers were all short, and they were short naturally because they had underlying, it may have been raw nickel or ore, not fully refined, but they did have underlying product that was just being moved or in transit, besides being maybe in a vault somewhere or in a storage depot. So it's a little bit, it's a little different mechanism. And LME, about 20% of the maybe the nickel prior to this was traded through the LME. 80% of the nickel is done more on an OTC basis or through commodity trading houses, things like that. So the issue that the COMEX has, and this is where I try to kind of relate this to the COMEX, is that with Russia and China, basically Russian bars have been no newly refined Russian bars could be put onto the market. So it's whatever's existing at the COMEX right now would be good delivery bars, but no new Russian bars could be brought in. And then you have this tariff from China brought in. That eliminates two major producers of the metal or those metals out of the market. So what you end up having is, obviously with paper contracts, it can trade a lot more than the actual physical. There's a leverage scheme that gets involved with regard to, especially when you deal with options and so forth. Beyond the position limits, basically, you do. The COMEX does have position limits, and that limits the initial position of one player. But if you have just multiple players start coming into this market, like for example, if silver starts busting to the upside, it goes to $40 or $45 an ounce, and all of a sudden someone says, you know what, I think it's time to take some profit. I don't want to sell my silver because I don't want to pay taxes, but I want to hedge the price action, and they go ahead and sell calls, or they say they short against, short a futures contract, and they, for example, have this silver sitting in London, and they didn't know about the Chinese market or the Chinese bars, or you just start seeing a demand for delivery starting to come into the COMEX and start draining supply. The contract could start rising in price, and all it takes is a hedge or two to start blowing up, forcing even higher prices. And then, but the scary part though is just the limitation of metal that even though the COMEX back in 2020 widened the list of refiners that could come onto the market and gave the perception that, hey, listen, we just brought in an untold amount of potentially new supply. A lot of that new supply now we're finding out has actually been curtailed either through tariffs or political actions. And that the question then is, if something else happens in the world and the U.S. imposes potentially more issues or more controls onto the COMEX, it may affect other bars from other locations. So it's just not to say that this is a high probability event at this point, but you're trying to uncover the structure of the market to know where the weaknesses may lie. So if you start to see pressure build in certain areas, like you saw with nickel, where that pressure could come from.
Absolutely, Bob. That's interesting, and of course, the kind of the opacity of the market is always something to consider. And we can't always get the perfect answers that we want to know, right?
Yeah, it's the hard part about investing and trading and so forth is sometimes you learn most when you lose money. And what we haven't seen in this market yet, and we could talk about it today, is how do you actually make silver and gold more mainstream? How do you make it where silver is potentially traded as money on a more mainstream basis, or used as barter and so forth? The problem we run into right now is people, even though you see good physical buying, the idea of taking delivery off the exchange may not be on everybody's plate. And so a lot of institutions out there are still under the mindset that they'd rather just go into a security or have some type of structured product to represent their silver position, even though that silver position may not have anything to do with actual metal. It's just all it is just basically some type of linked note or derivative contract that gives some type of emphasis on the bank or the counterparty to produce some type of return, whether it's betting for or against the actual underlying price, not necessarily the metal. And there's ways to actually build upon the market, especially the dollar is rising right now. I'm sorry, can you hear me?
Yeah.
Okay. Yeah, the dollar's rising right now. It's certainly screaming higher, and that at some point, it's we're talking. There's obviously a liquidity squeeze that's going on right now with the Fed talking about starting to curtail the balance sheet, especially next week's FOMC meeting and so forth. And so the market's starting to see. I guess you're starting to see some unwind of quite a bit of leverage, and a lot of the speculative froth is coming out of the market. But at some point, the dollar is going to hit its peak, because if the dollar continues to go higher and higher, ultimately that'll choke off the economy, because our goods will be priced much more expensively in the global market than, say, a foreign country's good, especially with potentially higher rates and so forth. That'll also be a headwind to our economy and so forth. And so eventually the dollar will start its decline. What I think a lot of commodity investors and a lot of macro players probably think is that at some point when the dollar squeeze is sort of over and to run its course, the drop, when it starts to happen, could be pretty tremendous, and it could be pretty sudden as well. I mean, you'd see because there's a lot more dollars held overseas than there are in this country. It was 70% of the physical dollars, for example, are held overseas. So you could see that snapback eventually happen, going from extreme.
If I can add to the macro for a second, Jaime Carrasco here.
Hey, Jamie, thanks for joining us.
Yeah, on the macro picture, I think you got to look a little bit higher, because you got to look at what's happening with Japan right now. You guys were so part of the discussion, and it's good. We're talking about a force majeure, a default of some kind on the commodity side. And really, as long as they can print money, that facade can continue a lot further, right? I think silver will be the first one to crack. I think David Morgan, who I see is on board, can talk about that later. But silver is definitely the tight one. But forget that. I think it's more important to look at what's happening with the yen right now, what's happening with gold in yen. Gold in yen is going through the roof because the yen has broken down from a 30-year spread between the dollar and the yen. It's more important to look at the currency swaps on the derivative side, because this could be bigger than AIG and it could be very bullish. So yes, so I agree, the dollar is rising because the yen is crashing, but the bigger problem is the spread between the yen and the dollar has to maintain a certain level to keep those derivatives in check, right? Or else we could have a massive, it's like tea and nitro right now, and the volatility between the two, at some point you're going to have a liquidity crisis. So yes, the dollar will crash, but it could happen overnight, because that means what we're really looking at is the fact that all the fiats are starting to go because Japan goes. And why is it going? Well, inflation is out of control. That comment by the IMF that they were like a bunch of 8-year-olds playing with, unintended consequences, they've lost control of inflation, and Japan will definitely be the first one to see it or feel it, because the demographics is so much older. They have to pump so much more out of the pension funds. Interest rates are declining. The value of the bonds are going down. So really, the central bank is the only one that can buy up that liquidity, right? That can keep the system going. So they got to print. So because of that will only accelerate from here, and the spread will continue to widen between the yen and the dollar, and that's the bigger problem. But that's great for us, because what's happening to gold in yen is also going to happen to gold in the dollar. And I think at some point, I think silver is going to be the one that is the tightest, it seems to me. And that's the one that's going to be the catalyst, and then gold will turn. And I think we'll first see it in the companies, because there's too much value in the companies right now.
I see we have Peter Boockvar joining us too. Do you have anything to add to that, Peter?
Not really. I do think that the BOJ has two choices. Let the yen continue to weaken to maybe even something like 150, which would not be a surprise. That's where it's been before for sure. Or they widen the band of yield curve control, and we get a major earthquake in the world's bond markets. So it's an untenable situation, and a choice is going to have to be made one way or the other, because this is not sustainable. You have just conflicting messages just within government statements. I mean, on Wednesday, the prime minister said, we want 2% inflation, but then said we have to guard against the risks to higher energy and other prices, which obviously doesn't make sense. You have Kuroda that says we need to maintain yield curve control, but then says he doesn't like the weakness in the yen. So it's a complete mess. I do think the bottom line is that the BOJ would rather see weakness in the yen and higher inflation than risk a rise in interest rates. Because with the amount of debt that they have, the rise in interest rates is actually their biggest risk.
Peter, I was going to ask you as well. We saw expected GDP was supposed to come in at, I think, around 1%, and we saw it actually come in at negative 1.4 or something, I believe. So how do the optics look like that? And maybe how does that affect the dollar as well?
Well, it was all trade. I mean, trade took off more than 300 basis points from the GDP report. That and inventories were a drag as well, and so is government spending. So I really don't pay much attention to that GDP number, because I don't think that it's an accurate reflection. That said, I do expect growth to slow going forward. I mean, consumer spending is inevitably going to slow. Trade is obviously going to be a major drag. So by the third or fourth quarter, you'll see actual, real possible contractions in growth, rather than this I don't want to say one-off in trade, but a pronounced impact of from trade.
And I guess just a general question for you guys. How do you see, because I remember Tom Luongo kind of had come up with this idea that Japan is going to be the first to really crack up. So I'd like to get your thoughts towards how, Japan's currency weakening versus, let's say, the dollar and the euro, how that could affect maybe the euro next.
Well, the benefit that the euro has is its trade surplus, which is very large. But the negative, of course, is this crazy monetary policy. The problem with the dollar that could see it rally at any time is the massive trade deficit. The goods trade deficit from March hit an all-time record high. It was supposed to be 105 billion. It came in at 125 billion. So it's not like the dollar is just this great currency. All it's doing right now is just trading off interest rate differentials. If all of a sudden currency markets decided to turn that around and start to trade off another factor, then the dollar strength will end. And even the dollar strength has been mostly against the yen and the euro, and also in sympathy with the pound. It's traded poorly against all the commodity currencies, which obviously makes sense. The Brazilian real is traded great. Even the South African rand has traded well. The Mexican peso is traded well. Even the Canadian and Aussie dollars, because of the commodity exposure, have traded well. So I don't like to say the dollar's up or the dollar's down. I think people need to get more detailed.
Yeah, it's just a really relative measure, right?
Correct.
Anything to add there, Jaime?
Thinking about it more, again, I go back to, I look at the bigger picture, and I'm looking at Japan, I think will be important. Europe, I think, I agree, but I guess we'll have to wait and see what happens with the Russia situation, the geopolitics. I'm more fascinated by this currency that is being discussed out of Russia and China, and even India's listening, and I know Brazil's listening, with some kind of a gold peg. But I read a really good article or interview of the chap that's advising China and Russia and now India. And what he's proposing is some kind of a commodity basket within the structure, because I think that would be an amazing currency reserve. And I'll tell you why, because the problem with the gold standard is that it benefits he who has the gold holds the power. So they control the purchasing power. So a country like Chile, which is a big producer of copper, doesn't benefit, right, too much. So by adding a commodity basket, so that copper would definitely be in the mix. I think it's about 8 commodities, food and metals that they want to add to the basket. It would benefit a country like Chile. It would benefit any country that, like Saudi Arabia, having oil within the component. So Saudi Arabia's internal purchasing power wouldn't go as much as gold, but it would go in percentage to the basket and the structure. So I think that would be very well accepted by the rest of the world, or definitely by the emerging markets that need to trade with Russia and Saudi Arabia and all these countries that are definitely lining up behind this system. China is the consumer, and they have quite a bit of gold on their side. So, they would benefit from that perspective in terms of the distribution of the purchasing power of whatever's going to be used in the new SWIFT. It's definite that we're not going to use dollars or euros. That's done. So I find that mechanic very interesting. So do we have some kind of a catalyst where it's a weekend event like in 1933 where they just shut it down? Well, I think that is up to the new power, whoever's going to restructure that, and that's China. China, definitely India. And so whatever's happening over there, I think we have to keep an eye on. Inflation is the big problem, and that I think is definitely, if there's going to be any kind of decline, might not happen just yet because of what's going on with energy, the full implications of everything that's going on right now. We're just too dependent. We have to understand that the global system, the globalization is done. We have to come back to the U.S. We have to come back to Canada, and we have to start producing here. The model of having China. So think about it. The model was having China produce cheap shit that we're going to borrow money to buy it with. right? Well, how much longer can we continue to borrow money? That's done. So, are we going to go? The fact that gold's trading anywhere around 1,800, I think, is amazing considering every other commodity. Copper still sitting at 450, right? They're not coming down. So inflation is getting priced in by the commodity cycle. The 70s and 80s are repeating, except for one thing: gold and silver still haven't gone up, and that's because of the derivative and how they control the price through those mechanisms. Again, if we have a blow up on the derivative side, that mechanism's gone. So we're going to see very quick movements happening. So that's what I'm expecting going forward. And I think we're getting there. Something's got to give. And again, silver is the one that I'm keeping the most eye on. And I would love to hear what David has thinks right now about the silver market and how tight is it, right? The other thing that's very interesting actually was the 30% inflation out of Germany, because it is 30%. And a lot of that is Russia, granted because of those issues, but also on how they calculate inflation. They haven't changed the way it was calculated in the 80s because the Dutch central bank didn't allow the adjustments that the European central bank wanted to do. Right, there's still quite a bit of power within the Deutsche Bank. Right, so I find that very interesting.
So, do you think that's a more accurate measure of inflation, Jaime?
Check out Shadow Stats. Right, so I'm sure he's through 20 now for North America, for the U.S.
Mm-hmm. Jaime and Peter, maybe you can speak to this as well. How does the SDR fit in here, and if it can be, if they can just be kind of in some ways issued at will, how does that affect the other currencies?
Hold on,
as
the SDR. Let me talk about this very quickly because I was. James Rickard has been talking about the SDR forever, but that is the solution that the IMF and the Western banking system was presenting. Forget about the SDR because what it's definitely clear after the Russia situation is that new setup is the second door. We're going with the second door. It's going to be set up by them, right? And we're going to have to follow suit. And so I think the SDR, which was a basket that was going to have gold because the Chinese weren't going to participate, but it was more similar to the Bretton Woods setup, right, where they still control the power. But what you really are seeing now from the way it's set up geopolitically is that they are setting up their own thing according to their rules.
Peter, anything to add to that?
Not really. I mean, with the SDR, I've read plenty on it, but it still, to me, just seems more theoretical on what would be an ideal situation, but not something that I see realistically happening for a while. I mean, the dollar will eventually will over time continue to lose its dominance, but it'll still be a major reserve currency. And yeah, China and Saudi Arabia will price their oil transactions in yuan, and Russia will with China. And over time, that dollar, that petrodollar, will lose its tie to the extent that it's been. But what will replace it? Yeah, on paper, the SDR sounds great, but I just don't know how this is going to go in terms of like there being a formal replacement, or things will just sort of splinter in its own way.
Nothing to add to that. I would agree. Or actually happen very quickly if we have an AIG type of event.
Mm-hmm. David Morgan, are you available to chat about the silver market as Jaime was asking?
Yeah, I'm ready to go. First of all, Jaime and Peter, thanks for your contributions. And Bob did a good job on the details on this quote-unquote blow up in the nickel market. I mean, if you're truly hedged, then a hedge means if you're losing on the futures, you're gaining on the actual metal because you're 1 for 1. If you hedged 1 million ounces and it goes one way or the other, you're delta neutral. But there are intricacies, and Bob explained that, so thanks. As far as, I don't know who's speaking, I'd address them, but on the position limits, there are position limits on the COMEX for silver, but they hardly ever enforce them. Once Buffett took the 129.7 million ounces off the COMEX, they implemented a position limit on the longs that you could only take 1,500 contracts, which is 7.5 million ounces, as we know. But that isn't enforced. It would help if it was, but it's not. And then as far as the silver, so here's, I just finished the report, looked at the data pretty hard, and read the Silver Institute's press release. I haven't gone through the manual or the silver survey because I didn't have time. I had to write. But so last year in 2020, we had a record silver investment, like unprecedented, something we'd never seen before. We had 530 million ounces of silver on investment demand, 320 million ounces through the ETFs, and 200 million ounces, round numbers, through the retail market. That was greater than the industrial demand, which is always 50% or higher of the silver market. And that, of course, took the price higher. Since that time, going into 2021, where we now have the data, and we haven't got it from CPM yet, but we've got it from the Silver Institute. The retail demand was up 36%. I forget the exact number. I got a good mind for numbers. The thing was 272 million ounces. You don't have to quote me, though. So retail added and has more momentum, which makes sense with the Wall Street silver guys and the press that silver gets in the truther movement. You don't see it on CNBC, but you do hear it in the alt media. However, the silver on the ETF side is totally flat. In fact, it's actually down somewhat. It spiked either the end of 2020 or early 2021, I believe, is when it spiked during the quote-unquote silver squeeze. It's backed off. It's been straight flat ever since. If you look at the report that I just mentioned, the Silver Institute, they said it increased 65 million ounces, which on the scale graph that I was looking at is probably about right. But 65 million ounces is a little more than I've got, but it's nothing compared to 320 million ounces from the year before. And then, of course, there's really the most important question for me is what I keep asking and telling people is it's, the demand for physical is met at the margin. In other words, the reason you got to pay $10 for a silver eagle is that's the highest price that it'll bid because someone wants to pay up that kind of a premium to get that particular product. But going into the silver market, what we've seen is a higher spread on commercial bars. But where are those commercial bars coming from? So how do we get that 320 million ounces that went into the ETFs in 2020? And I finally figured it out. Now, is this exactly it? No, this is conjecture and very educated guess on my part. But in 2020, the rupee was, the silver price in rupees was the highest it's ever been. So that'd be like us seeing, $150 silver in US terms. COVID hit, and the poor people in India save in silver, not gold. And now that they're more prosperous, there's a lot more gold bought by the citizenry. Anyway, the point being, massive amounts of silver left the pockets of the Indians, as a metaphor. Did it all come from there? Of course not. But now, where are we? And this is the one that really boggles my, I won't say boggles, but really has got me thinking. I haven't thought all the way through. Maybe some of you smart guys can help me. It looks like what's going on in the banking side is Deutsche Bank is blowing up. And they're blowing up big time. And what are they selling? Silver. Massive amounts of silver. They sold like 16.5 million ounces in the last month, about 33% of their holdings. But you look at my friends from Zurich Continental Bank in Switzerland, and they haven't sold anything. In fact, they've added a slight bit. So there isn't any silver at the margin. I mean, all that they're getting, in my opinion, is, whatever Deutsche Bank could supply. And at the rate they're selling it, they got about 2 more months worth. So the market's much tighter than most believe. And I think it still is the Achilles heel of the financial system. And one more comment, and I'll turn it over to everybody. Ronan Manley did a great job in explaining what this Russian basket of commodities gold included would look like. And I think it's a great idea personally, that we have something tangible and people aren't getting, as one of you said, borrowing money to buy cheap shit from China. I mean, it can't go on forever. And I think we don't have many days left, but personally. So hopefully that gave you kind of an overview. I'm still bullish silver. I'm disappointed in the price action, but that's just derived by so much more money is on the derivative side than in the physical market. I mean, most people that buy silver hold it. Some will, trade it, sell it, swap it, whatever, but it's more or less dead money, and people do it right. And what does right mean? It's individual case, but you buy a hedge position, maybe 10%, maybe 5%, and that's it, and you forget about it. And the derivatives market has got such a grip over everything. I mean, the guys are both, I think, Jaime and Peter are much more adept at the currency markets than me. I don't do much in the currencies anymore, but I had to laugh just thinking the last time I was playing the yen, it was like 100 to 1. Now it's 150. So anyway, back to you guys. Thanks.
Yeah, if I could just add, I think it's important to talk about some of the price drivers that's hitting the metals right now is forced selling. You're seeing, liquidity tighten up in a lot of markets. Obviously, interest rates have been backing up. The bond market's been getting hit pretty hard. You've had, some fast money come into the market, into the commodity sector over the last, month or so since Russia invaded, and that's being unwound as well. But one thing that I've looked at quite a bit, and it's something that would actually help the premium structure of retail products, but maybe not necessarily the mindset, is that a lot of these dealers and structured programs have created these loans or borrow against your gold and silver type programs. And usually when you get into these liquidity events, and this is one of the reasons why I was mentioning earlier this week, when you start to see these sort of moves in the market where they get into this one-way direction, or the market just cannot get up out of bed, and something's pinning it down. It almost feels like there's some type of forced liquidation that's going on, margin calls, whatever you want to call it. What we could possibly see if the market continues to see more pressure is some of these dealer programs may actually start to unwind. People that are that may not have the money to cough up to cover their loan, and have been basically surprised by the weakness of the metals. That's something that should be kind of mentioned, or at least brought to the forefront. And that's what I try to do, because that could bring in some secondary selling into this market, which in all actuality, it would actually help bring premiums down, because that's something we have not seen is secondary product coming back into the market.
I've got those numbers now, Tom, for the silver and the gold for the week. The gold looks like it was up $48.90, 5 o'clock from last Friday to 5 o'clock this Friday. And the silver's down about $1.54. So the silver finishing, the July contract finishing under $23, not the best. I might add that it's my opinion that the futures market is moving this market. And I've been of the opinion for 10 years or so that when the banks get long future, there won't be the selling overhead. And that's when the market really goes. Not quite sure when that's going to be, but I think that as a trade desk, as they look at $1 or $2 downside from here versus $10 to $15 to $30 upside from here, getting back near $50 or so, there sure is a lot more upside than there is downside.
Mm-hmm. Thanks, Jim. I know we had a question from somebody. What's the open interest on the May contract now compared to previous months?
The May contract is only about 6,000 going into delivery. It actually started last night at 6 o'clock. So if you look at the delivery, it's going to have the intent date of yesterday, but today's the first notice day. When I looked this morning, it was 6,034 contracts, something like that. Not a big deal. The July should be a lot bigger. The July open interest is well over 100,000 contracts. We won't have near that many standing for delivery when we get to the end of June, but May will certainly be better than April.
Jaime, did you have something to add?
I was just thinking on for silver on with the numbers you were just mentioning. Just a question.
Go ahead.
Go ahead, Jaime.
The question was on the contracts for. You gave the comparables for gold. What are they for silver? How tight is silver now that the contract's rolled over for May?
Well,
do we know yet?
May is in delivery as of last night, starting at 6 o'clock Eastern.
Okay.
And I'll give you if when I looked this morning, there were 6,034 contracts waiting for May. I'll give you the first.
But that was for silver. That was for silver.
That's May silver, 6,034.
Okay.
As I recall.
Okay.
And the first day of delivery for silver was 1,672.
Okay.
So if you add 6,000 and 1,600, you have 70. Call it 8,000 contracts potentially standing for delivery. That's not that's a guesstimate because people can add or subtract in the delivery period. Delivery period starts from last night at 6 o'clock until probably the 28th or 29th of May. I don't have the last trading date in front of me, but it normally lasts about 28 to 29 days.
Got it. Thanks.
Hey, Jim, when somebody stands for delivery, I know you and I have gone through this several times, but I think it's always helpful to kind of reiterate. When somebody stands for delivery on the COMEX, do they get to dictate if they want physical or not and force the supplier to give them physical, or is it up to the contract holder that they're buying it from to dictate the terms of that contract?
You're kind of partially right on your either or. The short gets to decide which day the delivery happens, but the contract demands that cash gets traded for physical silver. Now, I know that there's people around that there's rumors that say people are getting settled in cash. Well, that might be, for example, if Tom Bodrovics is long a May contract of silver, and next Tuesday, his wife says, we're buying a new house. So Tom calls up his broker and lets his long go. He liquidates his contract because all of a sudden he has further need for the money someplace else, maybe stocks or real estate or something else. That's up to each individual trader. Traders can add or subtract during delivery period of the front month contract if they choose to. It's up to each trader, but delivery does happen monthly. The short decides the day, and it's T+2. If the short says, all right, I'm going to deliver to Tom next Tuesday, all right, Tom's account has to be fully funded, and the futures get settled up on Tuesday, and Tom gets the physical silver in the warehouse through the warrant, through the title to the silver at T+2. So the futures, his futures position gets settled Tuesday. His cash gets swapped between Tuesday and Thursday morning or so, or at the end of Thursday's business day. Tom has title to the silver. The short that gave him the silver has title to Tom's cash.
Perfect. Thanks, Jim. O'Hare, go ahead. You've been waiting patiently here. You wanted to add some color to a couple things.
Could I one more time, Tom? Could I just please?
Yeah.
While Mr. Morgan is on the meeting tonight, Mr. Morgan, if I can please ask you, I think I remember 10 or 12 years ago or 15 years ago, I think I remember, I'd just like you to just confirm that you did take delivery one time of one contract. Is that true?
I've done it a few times. Yeah. Yes. And it wasn't, I took a delivery of a mini when I was like in my 20s or early 30s. And I've taken another delivery or two, had it shipped to a minting friend of mine, but yes, I have. And, to add on to what you said, Jim, I've only gotten a few, and, I don't know all the details because people are really good at kind of just presenting the case they want you to see. But a couple of people have sent me their correspondence with their broker standing for delivery and then end up getting a check. But you don't know the total truth. What I do know is maybe he couldn't get the funds in 2 days, or their bank didn't know how to wire it that fast. The wire didn't go through. I mean, there's details that I don't get. But what we do know, when Buffett took the 129 million ounces, the exchange could only settle for 90 million. So they had a 40 million ounce deficit that did get to Buffett eventually. But the lease rates went sky high until that silver was delivered. And all that silver went to London. And miracle of miracles, the SLV was started with 130 million ounces, the same amount that Buffett had bought. So there's a lot in the silver market that people don't really understand. It's a very esoteric market, and there's a lot of it's opaque, but there's a lot going on behind the scenes that none of us, including yours truly, will ever know.
One interesting detail that I'd like to just make sure that everybody, at least Mr. Morgan, is aware of. When Mr. Buffett did his deal, and he exercised an out-of-the-money option that he was long. He was long the contracts through options. He was long call options. The market settled, and he instructed his broker to stand for delivery for the contracts. Okay, so the options expire 4 or 5 days ahead of first notice day for delivery. So it was a big surprise when he exercised his out-of-the-money call options, which should have expired at 0, but he had the right to exercise his options at his strike price, and then he got futures contracts that following Monday, let's say. So there was ample notification that Mr. Buffett was going to be in futures contracts after his options expired.
David, if you could explain to us again where you think that Buffett silver went to, and what that was, what vehicle that was? The same amount as something else?
Well, so Buffett bought let's make it round numbers. Buffett bought 130 million ounces of silver. And, I didn't know where he put it. I don't have a direct line to him. And one of my guys was over in London, and he called me up and he was madder than a hornet at me. And he said, "You are wrong." I said, "Well, I've been wrong before. What's the problem?" He said, "Well, you said there's only 50 million ounces here in the warehouse, and there's like 100 and ounces in the warehouse." And I said, "Okay." So I hung up the phone and I called Jeff Christian. I said, "Hey, Jeff, your latest report says there's only 50 million ounces over in London. This guy's saying there's like ounces." And Jeff says, "Oh, that's Warren Buffett silver." I said, "Oh, okay, thanks." Well, 130 million ounces is what the exact number that the SLV started with. So was the SLV started with JP Morgan using Buffett silver? I'll let you determine that. I don't know for a fact. I know the number matches. And I also know it's in London. So, you have those two factors to think about.
If I can just weigh in slightly, and Mr. Morgan could do some checking next week if he's at all interested. The way I understand it is that Mr. Buffett had some sort of issue with the SEC with an insurance company that he owned. Okay, he owns Geico, and he might own another one. I'm not quite sure, but he was supposedly told to divorce himself from the physical silver that he owned. And that's where Mr. Morgan's comment that the SLV started from. But it probably wasn't a willing transaction from Mr. Buffett. It may have been forced by one of the regulators. And Mr. Morgan could look into that if he's interested.
Yeah, I've heard that before. I've never been able to verify it, but I'm pretty open-minded. So I'll leave it at that.
Almost nothing would surprise you at this point, would it, David?
Well, in the silver market, that's why I have to wear a tinfoil hat. I see Keith Weiner's on here. Welcome aboard, Keith. He knows I have to wear one anywhere I go. But there's a lot to it. And silver's, there's nothing in my, of course, unbiased opinion that's stronger as far as the modern technological society than oil, and silver's number 2. Without silver, we're in dire straits, and we have not got... the demand keeps increasing, and the investor community is catching on retail-wise. And I think the banks have been told to just downplay it as much as you can. The banks aren't buying. There's been no net sizable increase in the ETFs for over a year, which is very surprising to me.
Yeah, absolutely, David. Keith, if you want to weigh in on anything here, jump in at any point. O'Hare, you've been waiting patiently. You had. Oh, go ahead, Keith.
Yeah, I was going to say, let me jump in with a couple of comments. One, I would de-emphasize silver or gold, for that matter, coming into or out of any particular warehouse or any particular custodian. If silver goes into SLV, well, that's famous and everybody can see it, but that means it came out of something else. Whether it's Brinks, whether it's Delaware Depository, metal moves around all the time. These are monetary metals. The stocks of these things are much, much, much bigger than what you see trading in the market which is the margin at any given time. Second comment I wanted to make is that as the price of silver was rising, let's say going back to February, we've had we had a pretty significant rise through early March. We first had for folks who are not familiar with my work, I follow the spread between futures and spot. And both of those prices track each other very, very closely, but there are arbitrages between them and the spread, and therefore the arbitrages can tell you something about the market. As the price was rising, we had a big increase in the silver basis, which means the price of the futures went up relative to spot pretty considerably. And then, it stayed kind of at a plateau. We had a peak in that at around middle of April. And since then, that's come way down. So I just want to confirm that, somebody earlier, I don't remember who, said that a lot of the selling has not been physical product coming to the market. Premiums are still high, but it's been selling of silver futures. With that, I want to give a little color on that. I don't see, and I've written many forensic analysis of these events, going back to 2013, I think, or 2012. It's not like there's a massive selling of paper only, and then the price of paper drops by $2 while the price of spot remains the same. Spot and paper both going down together, with the spread between the two changing by pennies. But that change in pennies is significant. It's a sensitive indicator. So since mid-March, we've had the July basis being 3.5-4% on an annualized basis. So that, what does that work out to? Something like 20 cents, 23 cents an ounce difference between spot and futures being higher, coming down to below 1%, or, let's call it 6 cents an ounce or something like that right now. That's a big difference. And then that's been occurring as the silver price has been falling. So there's been the selling in paper has been leading the selling in physical, but they're selling in physical as well. Otherwise, these spreads will get way out of whack. Compare and contrast to crude oil, which has been, so this is called contango, when the futures are trading at a higher price than spot, which gold and silver are both in contango and have been for quite a long time. In crude oil, we've had a backwardation. That is, the futures price is lower than spot, and the next future is lower than that, and the next future is lower than that, all the way out. And that indicates a scarcity or a shortage, which of course in crude oil makes sense. The energy market's been all messed up by, Russia and Ukraine, and frankly before that. But the gold and silver markets are in a relatively normal state, but this sell-off in price has been accompanied by a fall in the basis, which means a decrease in the abundance of silver or an increase in its relative scarcity. So based on this alone, I'd say if we're not at least at a local minima in price, we're probably getting pretty close to it.
Keith, where do lease rates come in there? Maybe in your analysis, if you pay attention to them, or does that start to show us major tightness in the markets to deliver on physical?
Yeah, let me. So I've got a set of charts that I can generate for all this stuff, and lease rate is definitely one of the ones we chart. So let me pull up silver lease rate, which I have not looked at in probably longer than I should have. Let me pull this up here. And I'm going to zoom out and I'm going to look at, I don't know, say 2 years, 730 days, just to see what this looks like. It's picked up a bit. Certainly, again, since that sort of April 13 date. So we calculate on our website using futures market data, public data. We calculate GOFO and SIFO and also the corresponding lease rates. And I think we've got, if not the only, certainly, the most accurate calculation of this. But what we're calculating is what we call the zero arbitrage point. That is for the forward rate for somebody to borrow at LIBOR, buy the metals, et cetera. What's the rate at which it would be a break even? That doesn't include the bank would want to make a profit, and that doesn't include any kind of credit premium. But there's been a kind of reversal. The silver lease rate been falling since before the beginning of the year. Let's call it early December. It had been falling, and now it's risen back up to its highest point that it's been. I just pulled up 2 years with the silver lease rate. We're higher than we had been, in at least 2 years. So yeah, it's getting a bit tighter.
Do you have any way of going back a little bit more than 2 years, Keith? Because I thought that we had a big spike in lease rates, right around March of 2020 or something like that. That's the reason I was wondering that.
Let me pull up 1,200 days and just see what that looks like. Everything went completely bananas around COVID. So we had, we had a tiny little spike into like March 17, 2020. We had a total collapse, and I think a lot of the data becomes very spurious because the spreads got just completely out of whack because you couldn't ship. A lot of these arbitrages rely, it's an arbitrage between New York and London. Mm-hmm. And I think a lot of traders got caught with their pants down because suddenly and metal goes in the belly of an airplane, which is usually passenger planes. Passengers not flying, suddenly you can't ship metal around, and all kinds of weird things happened. And the market didn't really recover for, call it the better part of a year. So before, we are basically back up to the pre-COVID lease rate as I zoom out. And I can how can I send this chart? Maybe, Tom, I can send it to you, and then you can disseminate out to this group. I have no idea how I can get this chart off my PC into Twitter Spaces, which is on my phone. I'm technologically savvy, but apparently not that savvy. But I can email you the chart, and you can disseminate it, I guess, or tweet it maybe to this group.
Perfect. Yeah, maybe just send it to me within Twitter Messenger if you can, or email it. That's fine.
I'll try to do that. Yeah, I can do that.
This the Spaces interface definitely could use some work, I think. But I find that's really interesting that the lease rates are higher now than at any point during the last, let's say, 2.5 years.
Yeah, no, it's definitely gotten tighter. And so if one wanted, in fact, I should probably write an update on our supply and demand report. If one was looking for an entry to either, sell a put or get long, you could pick a lot worse times than right now in silver.
Well, the 10-year rate doubled from like 1.25 to 2.75. That might be one reason.
Yep. Okay, let me see if I can drag this. There we go. I'm dragging it into my direct message with you, Tom.
And I'll tweet it out here in a second.
And then just with the tweet, just basically say that entire canyon where it drops to, a calculated minus 8%, all of that canyon is spurious. That has to do with the market just essentially losing all of its efficiency, spreads blowing out, very bizarre things happening from late March 2020 through at least call it October, November of 2020. That whole canyon, I would be highly suspicious of that and call that spurious.
Mm-hmm. And that's just simply because of all the weird things that happened in and around COVID.
You couldn't ship anything, right? Anything that relied on a passenger airplane was not going to go. Mm-hmm. And as a result of that, those arbitrages all broke, and very bizarre things happen anyway. So that isn't necessary. But on the other hand, I guess in a certain sense, you could say, yeah, no, because it's the lease rate collapsing is essentially saying, is the bank going to pay you 8% to lease your metal? No, of course not. Basically, the market's seizing up at that point and not really working for 6 or 8 month period.
O'Hare, I know you've been waiting for a long time here to add a little bit of commentary. Go ahead if you want.
All right. Hey, guys. Fantastic space there, Palisades. Got David and Bob. Great guests. Love to listen to those guys. Just had a comment on, can you guys hear me, by the way?
Yep. Go ahead.
Using some new headsets here. Just had a comment on somebody previously made a comment about Barclays or Deutsche Bank blowing up. Deutsche Bank's been a blow up, kind of a slow moving train wreck for quite a while. But it's interesting what people are. Some other guy mentioned ETNs and the fact that Barclays kind of pulled all their ETNs the other day. These are all, kind of signposts. I mean, in my mind, I remember in 2007, I'm sure you guys remember this too, all of these things are kind of happening all at the same time, but no one really was paying any attention. So back in 2007, right before the massive meltdown, a lot of ETNs were being pulled. A lot of auction market preferred securities were being pulled. Anything that had leverage, any of these structured products were being pulled. Barclays, by the way, they announced that they're going to restate financial statements through December 31st of 2021. That was along with this suspension of their ETN. So there is something going on underneath the belly of the beast here that it's hard to put your fingers on any one specific event. But when you talk about all of these events kind of together, happening all essentially at the same time, it again reminds me very much of what was going on in 2007, and even going back further than that, another 10 years prior to that, in 97 during the Asian contagion. I don't want to dox myself. I'm not a spring chicken, but I just remember a lot of these things, very similar things were happening. I just wanted to ask a question to the group here. I mean, you would think that the precious metals market, the sector here, gold, silver, would be behaving, a lot differently than it has been. I was on a space yesterday. I was hosting a space yesterday, and somebody on the space asked me, like, a long-winded question, and essentially what he was asking was, if not now, when? The price of gold and silver being so depressed. I mean, you would think that in this environment, gold would be already at $2,500, $3,000 an ounce or higher. Right. I mean, massive leverage in the system globally. Interest rates still being suppressed globally. The Fed is talking about raising rates next week. And again, you look at a date today. I said this yesterday. I've said it for the last 6 months. The Fed is not going to raise rates. They dipped their toes last month, did a consolation prize, if you will, 25 basis point increase. 50 was priced in. They did 25. The Fed funds rate was effectively 0 to 25 bound anyway. So 25 was, a non-starter in my mind. So this idea the Fed's going to raise rates, all this stuff's going on. The SPR question, that's a total joke. I mean, if you look at the basket of currencies, this whole thing to me, in my mind, is just pushing this just gigantic. I tweeted this a long time ago of this what's called an African dung beetle, and there's such a thing. It's a creature. It's a pretty big insect, and it lives on elephant shit, essentially. And what it does is it roams around and looks for big piles of elephant dung, rolls them up into a big pile, and saves them and eats them. And so I tweeted this out a long time ago, and I got a lot of people that thought that was kind of funny, but most people had no idea what it was. But this is effectively what everybody's doing globally, right? We're just pushing this pile of shit further and further down the road. At some point, someone's going to have to eat this shit. And I'm just not quite sure who it's going to be, if it's going to just be a massive blow up, if it's going to be shoved down, some one or other banks, sovereign banks. I mean, it's hard to say. I mean, this is uncharted territory. So my question to you guys is, the gold and silver experts, the guys that have been around longer than I have, what is going on in terms of the pricing of these things? I mean, I know that it's being suppressed. It has to be. But you would think that, in my mind, I'm going to wake up one day and we're going to see gold up, $200-$300 an ounce like that, just out of nowhere. Now, we may be sitting here over this weekend. I mean, you saw what happened to the equity markets here, which is interesting because the news from Barclays yesterday, right? And the fact that the Fed is days away from raising, some people think 75 basis points. All of this stuff is kind of coalescing here around, the U.S. central bank and, what they're, the dollar strengthening, what they're going to do. So I'm not sure that they're going to raise. I think the dollar's probably on the way, to making a 180 here pretty quickly. So I don't know. I just think we start putting all these pieces together. It's very interesting to my mind. It's hard to put it all into context.
One thing I would say with Keith's analysis on lease rates and the exchange for physical premium, which actually a couple weeks ago or three weeks ago or so got really, really high. I mean, you saw some, or maybe it was about 4 weeks ago, you started seeing a blowout to the upside, which kind of was reminiscent of the futures market. Somebody was in there buying a lot of futures contracts. And now that we kind of understand that Barclays may have been overselling shares or units of those ETNs illegally, I guess, should say unregistered shares. And that may have created this unusual demand into the futures market because that's what those ETNs are basically going into. Now that has kind of come off, that has unwound the futures price, but the EFPs actually have been collapsing back down. They've normalized and started to go south, but oddly, silver's almost at like 3 cents differential between spot and futures and the July futures, I think on silver, but the platinum has gone severely negative, which is showing backwardation, and that kind of corresponds with potentially a physical market that's starting to get pretty tight as these prices go down. It's very consistent to what we've seen the last 3 years, is that every time you get this smash down in price, the physical buyers wake up and say, okay, this is wash, rinse, and repeat. And all of a sudden we're going to start buying again. That starts to put the floor under the market. The shorts start to cover, and then the market starts to drift and starts to move higher again. So that would make sense that the sentiment obviously is pretty bad right now. No question about it. I mean, you see a lot of tweets out there, a lot of people that were pro silver, pro gold. Basically, I mean, the last week and a half has been basically, like a cold shower for many people out there. But this is the type of sentiment you want to see. The only question, I think, when you close on a low on a Friday, it usually is not good for Monday. And that's where the concern would be from a liquidity event standpoint, is maybe the Fed is wanting the market to do its own bidding, so it doesn't have to tighten policy, because everyone knows, I think, at the moment they start to run off the balance sheet and you have the federal, the U.S. government, after these tax receipts are done in May, they're going to start going back to the market and borrowing $100 billion. And if the Fed isn't buying the bonds at that point, somebody's going to have to. And that's going to be even more tightening on top of the idea that they're not even adding to the market anymore. Plus, you have mortgage-backed security securities that aren't refinancing anymore because interest rates have risen. So that's that refinancing, the runoff on their mortgage
books,
the mortgage-backed securities. That runoff that was bleeding from the Fed, and then they were going back into the market, replacing that. That's pretty much done too. So
Bob, that's a great point. No one talks about this, but this is a great point. This idea of this slow runoff over the next 5-10 years. It's if the rates are going up, no one in their right mind, everybody, the whole world has been refinanced at effectively the zero bound. I mean, it's as low as possible. I mean, junk yields were 4% not too long ago. 4%, right? I mean, that is insane, right? That's never happened. So what it tells you is everybody and their fucking mother has been refinanced over the last decade. I mean, if you haven't, then you're a fool, right? So the idea that we're going to have this runoff and we're going to have this refinancing in a rising interest rate environment is a non-starter. This makes absolutely zero sense, right? So but people, it's like I remember 15 years ago, real estate agents and mortgage brokers would just tell people, look, you just keep buying a house. If rates go up, you could just refinance. And that's where that's where it ended. That was where the conversation ended. And I would always say when somebody would say that, think about what you just said. If rates go up, no one's going to refinance, right? If the market tanks and rates start to go up, it's the worst of both worlds. Prices are falling and rates are going up, right? So, for the last 40 years, we've had declining interest rates and increasing, asset prices. I mean, it's very simple. Look from 1980 to 2022 and just do a chart on the 30-year Treasury and do a chart on assets, the Wilshire 5000, whatever. Pick a real estate prices. It's literally one going from upper left to lower right, the other one going from lower left to upper right. I mean, literally, that's what's happened. So now we're in a quandary, right? Now we're on the opposite side of the spectrum.
If I can just butt in here, the drivers of that trend are still intact. This is a correction like many we've had in the last 40 years, but there's no way that interest rates can rise significantly or durably.
That's Keith, you're absolutely 100% right. That's exactly my point.
I think that the big question, and there's a lot of smart guys out there that I follow, and they make a very good point. George Noble makes a very good point that the biggest surprise here would be interest rates do move higher, and then something does break at that point at a much larger scale.
Well, it's breaking all over the place. Look at financials. Look at banks. Look at bank stocks this quarter, right? Last quarter, everybody, all of Wall Street, every analyst on Wall Street that covered banks was buy banks, bullish banks. Rates are going up, buy banks. Net interest margins are going to do fantastic. You got to buy banks. And if you were one of those fools that bought banks, look at the losses in Citibank, Bank of America, Wells Fargo, Citigroup, Barclays, Deutsche Bank. I mean, the list goes on and on and on, right? So we're seeing that it happen in front of our eyes. I mean, all of this is unraveling. I mean, today's close for the S&P, the NASDAQ. I mean, it just blows my mind. I mean, it just blows my fucking mind what is happening. And that's why anybody that thinks that the Fed next week is going to raise rates is crazy. They are absolutely not going to raise rates. In my mind, they're going to find a reason not to raise rates. They're going to keep moral sway. They're going to keep jawboning, keep talking about this, that, and the other thing, and find a reason not to. And if they do, they might do another 25. I'm not convinced that that's even going to happen. They did 25 already. They haven't even started quantitative tightening. And look at where we are. Mortgage rates are near 5.5%, right? House prices. I just took a road trip, 2,000 miles. I went to all over the Pacific Northwest. And it blows my mind, right? I mean, you look at labor costs. I was driving through the middle of Oregon yesterday. In the middle of Oregon, little tiny town south of Bend, there was a McDonald's. Little town, maybe a couple hundred people, $15 to $18 an hour to start. This is in the middle of, this isn't the Bay Area. This is in the middle of Oregon. Presumably a lot cheaper to live. And yet this McDonald's is paying people call it $17 an hour. I mean, this is the problem for the Fed. On one hand, they have rising inflation they have to deal with. On the other hand, they've been pumping up asset prices for the last, call it 20 years, and effectively really pumping them up for the last 12 years, And so now they're going to have to, someone's going to have to eat the shit pie, right? Someone's going to have to eat it. They're either going to kill inflation and asset prices, or they're going to keep asset prices where they are, elevated, and hope that inflation is transitory and goes away. Right? And they've been saying that they think it's transitory. So I just think that they're going to use that again and say, look, on one hand, things are, pretty bad. But on the other hand, they're, it's not as bad as we thought. So we're going to take our foot off the gas a little bit. We'll reconvene next month. I'm just not convinced they're going to raise rates. If they do, it's pandemonium.
I was going to say they've got a couple of problems here. One is where's the demand for credit at the margin as rates go up?
Right.
If everybody was borrowing only when there's a downtick in rates, And so one of my favorite go-to examples for this is the car companies that offer 0% financing. I noticed that Dodge Ram is still, or Ram Trucks, I guess it's not Dodge anymore, is still offering 0% for 72 months. Now, obviously, that costs them money as a subsidy to offer. And with the recent uptick in rates, it's costing them more to make that subsidy than it used to cost them,
Keith,
let's say a year ago.
Keith, let me ask you this. That's a great fucking point. Think about it this way. All this nonsense talk about how great the auto sector is, how used car prices are at all-time highs, and just recently in the last week or two, right? And yet I've noticed the same thing. I'm watching commercials, right? GM, Ford, all the majors, they're offering these zero interest rate for 60 months, 72 months. We're back to where we were in 2007, right before the crash, right? They can't sell cars. If used car prices are so hot, why in the world are they selling brand new trucks with zero interest financing? They should be selling them at 8%. The demand is so high.
Right. The demand is only high on a downtick in the interest rates.
That's right.
And that's true in everywhere across the economy. Exactly. The demand to borrow money to
the other guy's point about refinancing mortgages. Who the hell is going to refinance mortgages now? The Fed is really nobody's going to do it, right? You have tens of millions of Americans that own houses, that have bought houses over the last 12 years, and every single one of those mortgages is a lot a lower rate. I mean, a buddy of mine just bought a house 3 months ago. His mortgage, I think it's like 2 3/4 fixed. It's at 5.5. Nearly. Who is going to refinance? Nobody.
There's also an issue with the lack of inventory, I think, with new cars. I mean, being in Canada here, going around, just driving around and seeing dealerships with literally no inventory on their lots other than a couple used vehicles. Yeah. So
then those dealers should be coming down here and buying cars from our dealers at 0% financing and shipping them there. There should be an arbitrage opportunity. The fact that this isn't happening tells you everything you need to know about the real health of the economy.
But don't you is there not a new car supply issue in the States that is commensurate with what I'm seeing?
Look, if there was, then they wouldn't be offering these incentives, right? I mean, they would be charging. There would be no incentives, right? The fact that they're offering incentives tells you everything you need to know about the health of the underlying market in automobiles, right? Trucks were supposed to be the hottest ticket item in the last year, literally, right? The trucks, you couldn't find it. By the way, that's a great point, Keith, that you brought up about the cars, because I had a buddy of mine that bought a truck. He was a Disney employee. He went off on his own. He sold his house in LA. He and his wife, this is like in the last 6 months, he bought a 40-foot trailer. He has 3 little kids. School was out. They were homeschooling because of COVID. So he effectively retired. He was at a high-level executive at Disney in Burbank. Sold his house, bought a truck, but he couldn't buy a truck in LA because they were out of trucks. He actually went to Northern California to buy this diesel 5.7, 6.8, whatever liter, something that can haul one of these 40-foot travel trailers. And he paid $10,000 over sticker. This is 6 months ago, because in LA you couldn't get a truck. And so in 6 months this has happened, right? Now they're giving you these incentives. So the market slowed way down, in a hurry, very quickly. So to your point, Palisades, I don't know. I mean, maybe there is a shortage of cars in certain areas, but certainly not everywhere. If there were,
I think the shortage is being worked off. And I think it's certainly not like pre-COVID normal. But I think
by the way, guys, how many people can actually afford? And he paid $93,000 for his truck. I'm not kidding you. $93,000, $10,000 over sticker. It was $83,000 for this truck. So how many people are buying $70,000, $80,000 truck? I mean, my wife's friend just bought a Tahoe, just a Chevy Tahoe. Now it's loaded, but it's $80,000. What happened to this? What happened to this country? 15 years ago, you can get a Tahoe for $45,000, 50 loaded. Now it's 90. I mean, it's just insane. So this goes again to the inflation problem. Everything is inflated.
To your point, O'Hare, how long can that condition persist? Right, like you said, at some point, somebody's going to have to eat that shit. That there's going to be a wall where people aren't willing to keep paying 10, 20K over sticker.
Exactly. So I think Look, the Fed wants to orchestrate a recession. They want to. The hardest part about everything that we're talking about is labor costs. They're sticky. They just don't go away. So the one way to get to kind of put a relief valve on labor costs is to have a recession. Because if you have a recession, then presumably employers can fire a lot of people, lay them off. And so rather than going to an employee and saying, look, you know what, Palisades, we just raised your minimum, by $5 an hour. So now you're making 22 an hour, but we got to take that back. We have to take it. We're going to pay you 15 now. That doesn't work. But what does work is, hey, business is slow, send out pink slips, right? Now we don't have to negotiate. We just fire you, right? And so in 6 months, we'll rehire people at a lower rate. So presumably that's, I think, the game plan. But, I just think it's such a slippery slope because if we go into a recession now, this time around, it's going to be worse than 08. I mean, it's going to make 08 look like a walk in the park. The great financial crisis was all about leverage. And if people think that we have less leverage than we did then, they're on something. There's so much more leverage in the system today than there ever was, ever. I mean, just look around. So this idea that the consumer is in great shape, yeah, certain consumers are in great shape. We talked about this last night. There's a segment of the population in the U.S. I would say the upper middle class to start, right, that are going to be fine. Everybody else, the other 90% of Americans, they're not fine, right? They're actually hurting, right? Inflation's hurting them. Putting $5 a gallon in your tank, that hurts people, right? Rental prices through the roof. Bay Area. I mean, I was just my wife. She loves watching these home shows. She's always on Zillow. She was showing me some homes recently. She's like, "This blows my mind. It's so much worse than 07 when you thought real estate prices were high in 07. I mean, they make 07 look like it's cheap. Like it's bananas now. As someone else pointed out, that it literally is fucking bananas. And when you have the stock market doing what it's doing this last week, it's telling you everything you need to know about what the big money's doing, what the big money's betting on, and it's pushing the Fed not to raise rates because everything's so levered. If you start raising interest rates, the cost of money goes up, kills leverage. It's very simple. In my mind, it's very, very simple. And furthermore, these banks, we have no idea. I don't know if you guys have actually looked at the bank balance sheets. We have a little bit. We don't own banks, but they're like a black box. There's a lot of off-balance sheet shenanigans going on. There's a lot of swapping of assets. I mean, there's just so much stuff that these banks have done amongst themselves to make it very, very difficult to actually put your finger on the pulse, to really know what's going on. And when you know what's going on, it's too late. It'll blow up. And you're starting to see that. I mean, the fact that Barclays is doing what they're doing, I mean, that tells you everything you need to know about how healthy that bank is. They're obviously on the hook for something, and now they're going to restate earnings for the full year. So, again, these are just signs. We saw this in 07. Everybody, I used to work at Bear Stearns, and I remember, we had a couple of hedge funds that started to blow up. And it was July of 2007. Even in July of 2007, the housing market was still going gangbusters. Yet you started to see signs of auction market preferred securities. They started to break, right? They started to go below money market accounts started to break the dollar. I mean, all this stuff started to happen. It was just little pieces of this collage, and you started to put this collage together. It wasn't until, essentially a year, 8 months later that things started to really heat up and hit the fan. So I don't know where we're at in the cycle, but if we're not in it already, we're very close.
So, O'Hare, when we see, or if and or when we go into recession this next time, how quick do you think the Fed steps back in, and how much liquidity are they going to have to pump into the system to be able to have any type of an effect, or the same effect that they had in March of 2020, or let's say March to May of 2020?
Right. That's a great question. And the answer to that question is, I mean, it's a hard question. That's a hard question to answer, but I'll answer it this way. The sooner they do nothing, the better. And they know this, right? The Fed has got to know this. The more damage they do to this economy, to the global economy, to this infrastructure that they built on leverage, the more damage they do, the harder it's going to be to recreate, to redo. So they're going to err on the side of caution, in my mind, and not do as much damage as people think they're going to do. People somehow think, all these analysts on Wall Street, I have several friends that work at some of these big firms, and they all seem to think that everything's fine. Now remember, if you live in, if you live in Manhattan, or you live in Marin County, or you live in Silicon Valley, or you live in Bellevue, Washington, right? Or you live in the suburbs of Chicago, and you are in this business, and you're making $500,000 a year plus bonuses and everything else, and you're driving fancy cars, and kids are in private school, then yes, you live in a bubble. I live in a bubble, but I try to step outside my bubble and really get a feel for what is going on around us, what is really going on, right? We all live in our little bubbles, right? I took a road trip. I was going to fly, but I took a road trip because I like to get in my car. I like to drive around, stop at these gas stations in the middle of fucking nowhere, stop at a diner, talk to people, see what's going on, get a pulse on what's really happening with the economy in America. And I'll tell you, from what I've seen just on my this road trip I took, it boggles my mind. On one hand, everybody's saying everything's fine and the Fed can raise rates, and yes, we can have a little hiccup and everything will be fine. I can tell you, if the Fed continues on this path, they're going to kill this economy. People are hurting. They're hurting all over the place. In California, small towns, Oregon, Washington, Idaho, Montana, they're hurting. Probably in the Midwest, East Coast, everywhere else is pretty much the same. So, to answer your question, I just think the less damage the Fed does, the better off they're going to be. And so the question then becomes, well, how much damage can they do by raising 50 next week? We already see how much damage has already been done. I mean, all you got to ask yourself is this. If let's say that we're still at all-time highs and everything's fine, let's say we're back in, say, October of last year, right, the beginning of the fourth quarter. Then I could say, they probably raise rates and maybe the things will be fine. The fact that we've already rolled over like this, pretty hard. I mean, what is the NASDAQ's down 25%? It's the worst beginning to any year ever, literally since 29, right? Ever, right? And not only that, but the bonds are crashing, right? Yield spreads are blowing out. I mean, literally, there are fires burning on every fucking on every field here. And you think the Fed is just going to sit around and juggle all this? Again, I just think people are missing the big picture here. This collage is it's a very messy picture, and this goes right back to what I said last night on a space I was hosting while I was driving home from my trip. Somebody asked, why isn't gold and silver, why isn't it behaving the way we expect it to behave in an environment that we're in, right? If not now, when? And my answer to him was simply, just because it hasn't happened yet doesn't mean it's not going to happen tomorrow. I literally believe that one day, and I've said this many times on Spaces, one day I'm going to get up on a Sunday, on a Monday morning, go to bed on Sunday evening, and I'm going to look at gold and silver prices, and it's just going to be one tick and then a gap up to another tick that's $300 higher, $500, what you pick a number. It's just going to blow the socks off people. And if you're not in it, and you're going to be chasing it. So the question is, do you want to hold gold and silver as kind of as a counterweight? It's not going to hurt you too much, right? But it can really, be a benefit in the event of a massive dislocation. And so that's the way I don't know when it's going to happen. I don't know. You guys are the experts here. You guys are, I run a small mid-cap value strategy. So, we own it because we believe in it, and it's helped us in the past. Like 2016 was a banner year for us. One of the things that helped us was having gold and silver miners. I mean, we were buying stocks at $2, $3 that went to 30 in 1 year in 2016. You guys remember this, right? So now they gave it all back, right? Because all of a sudden the fire was out, everything's fine. We're back to everything being copacetic. The Fed has been orchestrating this circus all the way down the road this whole time. We are literally, I think, at the end of the rope here. I just truly believe that. I mean, everything that I'm seeing, everything, the bond market blowing up, equities blowing up, home prices. I mean, even things like, what Keith said, how come these guys are selling trucks with 72-month zero interest financing? If things were that good in this economy, why would they be doing that? Right? These are the questions people need to ask themselves. I mean, to me, things are not healthy. It's very rotten. It's like this beautiful fruit you have sitting on your table, but then when you cut into it, it's just completely rotted out. Right? Looks great on the surface, not so great to eat.
They're selling the cars, but are they delivering on those cars? Like, is it just sales without delivery? Right? Because I know that
they might be shorting cars, I guess. I'm kidding.
Well, I wonder, because I'm looking at the dealership here in Canada, again, back to what Tom was saying, and it's tight and tight as anything. And we have the auto pack. So, we produce a lot of cars here in Canada, the same like as in the US, and it is tight, right? So there are problems there. But by
the way, that's a great point. That's a great point. I don't know the answer to that. Maybe it is tight. Maybe it's not tight. Maybe it's made to appear that it's tight, right? This is a facade. The facade is a fantastic word for this market. If you guys have ever been to Universal Studios theme park, okay, in LA, and you go to the back lot tour, and you take the little bus, and you're sitting on there, and you have the guy explaining to you how they make movies, and you go through this, back lot with the movie sets, and the word they use is facade. And the facade is a French word. It just means just the cover. So, you go through the door, and there's nothing there. It's just empty. Right. And this is the economy we've built. We've built this great facade. On the surface, it looks fantastic. But if you go and dig deep, it's just rotted. It's hollow. There's nothing there. And I think COVID saved the Fed's ass. If you think about it in those terms, COVID literally
the repo market 2019. I agree.
They say the COVID literally. Now, maybe the Fed came up with COVID. I'm not a tinfoil guy, but I can tell you it all stinks. In my mind, it's all just. It's very interesting how things kind of happen. Now, I don't believe that. I think COVID was COVID, and that happens from time to time, just like bird flu and swine flu and all this other stuff. But it saved the Fed's ass. The problem now is COVID's over, right? I mean, supposedly. I mean, I wouldn't be surprised if we have another scare, another bout of it with a different strain. I mean, who knows? I'm just saying. I'm just a skeptic by nature. I've been around a long time, and I just don't believe what I read. I try to kind of deconstruct what's going on around me, and just when you start to put these pieces together, high yield spreads blowing out. I mean, that tells you everything. And bank stocks doing what they're doing.
Which high yield spread are you looking at? Because I watch the B of A option adjusted spread, and it has not really. It's sort of ticking up, but it's not. Yeah. Blowing out just yet.
Year over year, right? You got to look at it year over year. So,
can I add there? Because I think we're looking at the yield spreads. We have had a massive, forget about the stock market. Look at what's happening in the bond market on the money that has been lost from yields running on the 10-year from 0.5 up to almost 3% today. And add that to the 15, the 20, the 30, and go back to the 7, the 5, the 3. All yields are exploding higher, which means that the bond market, which is a massive animal, way bigger than the stock market, do the percentage change in those interest rates and run it back to the value of actual equity that pension funds are losing.
So you're right. And so presumably the bond market's front running the Fed. So you could think about it this way, right? It's priced in. So they're going to do the 50. It's already priced in. The fact that it's doing what it's doing, to me, in my mind, it's front running a lot of rate increases. Not a 25, 50 basis point move. It's front running 3 or 4%. I mean, is the bond market really thinking that the Fed's going to raise short-term rates to 4% in the next year and a half? If that's what they're thinking.
I have a different take on that, though. I think the bond market is starting to price in real inflation.
I think you're right. I would agree with you.
Right. And that means that we haven't stopped here at 3%. We're going way higher. And Japan is leading that, right? Japan, think about what's happening to those pension funds that need to pull out a lot of money for those retirees that are getting older and need more money, and the cost of living is going up. So the Central Bank of Japan, all they can do now is just print money. I think we're on the other side of the Rubicon. Back to your point, though, here that you were mentioning about I don't think we're going to have time to see it, because if you look at every massive change, and I'm one of those that, in 2009, I said, we are at the end of the road, because who's going to bail out the governments, right? So what comes next is different, because in 2008, they bailed out a sector, but they transfer all that debt to governments. Now, who's going to bail out the governments? The central banks. All they can do is print money. So we're definitely at a completely different kind of shift. So that's why I'm not looking at, what I'm looking at more is what ship are they building on the other side, because that's got to come from Asia. It's got to come from, it's a power shift. I find it very amazing that we built this debt bubble from 2009 on. And I'm talking about derivatives. I'm talking about Fed balance sheets and all that. And China as well. They went on a massive lending spree that is blowing up in their housing sector. But by the same token, they took 20,000 tons from us, right? Physical tons that now they're sitting on within the Chinese consumers, because it all went through the Shanghai exchange, which is not for the central bank. So you have all this gold sitting within China. That shift has occurred, but the bond market was going to blow up sooner or later, and I think it's happening as we speak. And I agree with you. In 2019, what was happening to the repo market, I'm one of the repo originators here in Canada before they unwound Glass-Steagall, so I'm very familiar with derivatives and repo. And 2019, I thought that was done, and then all of a sudden COVID came and was the best thing for the central banks. But I think more what's happening now is that. And what I've been thinking about, okay, how do you take the ball away from the West and the US and transfer over to the new players? And I think those are the mechanics that we're watching happen. And those mechanics have happened before in the past, but do understand that when they pull the trigger on them is a weekend event. It just happens.
Right.
1933.
That's exactly right. It's the weekend event. You're absolutely right. That's and look, it could be this weekend. I mean, literally, it could be this weekend. I'm just saying, it could be next weekend, it could be this weekend, it could be, a month from now. We are close to something cataclysmic happening. When you start to put all these pieces together, I would be very surprised. Again, if the Fed raises this next week is, of course, every Fed decision day is like the most important day, right? They always say, it's the most important Fed decision since the last one, right? I mean, we'll see. I mean, I just don't. I think the Fed is in a quandary. I know that I've been in Jim's in this space, Bianco, and I've listened to some of these guys like him and everybody else. They're convinced the Fed's going to raise. They have to raise. I understand they have to raise. We all understand the Fed has to raise. What I'm saying is the Fed.
By the way, I don't agree with that even, but.
What I'm saying is a lot of people think that they have to raise because of this runaway inflation, labor, and everything else. They have to, but they can't. The problem is they've effectively, handcuffed themselves. They'd love to raise, but they're gonna blow up one thing or another. They're either gonna let inflation run hot or they're gonna blow up asset prices.
Let me just interject, if I may, and give my little 30-second rant on that. First of all, I don't think there is a right thing for the Fed to do because their central planning and everything they do causes harm. But if one's sole concern was consumer prices and one was recklessly, heedlessly unconcerned with all of the many other harms that would be caused by this policy, and one only wanted lower consumer prices, one would lower, not raise, interest rates. Each downtick in the interest rate is an increase in the incentive and an increase in the subsidy to producers to increase production. Put yourself in the shoes of a guy who owns a chain of hamburger restaurants, and you've got 57 stores, and in your back pocket, you have a spreadsheet, which is a business case for your marginal store, marginal being the one you haven't opened yet. You're waiting for a business case to come together. Interest expense is one of the big costs that turn your bottom line red in your business case. When they lower the interest rate, ding, your spreadsheet turns green and you have a green light to go add another store. As do the manufacturers of the grill equipment for your restaurant and the makers of all the stuff that the construction company will use, the glass and the cinder blocks and so forth. It is an increase in the subsidy. It is feeding the savers to the consumers via the producers. That's what a drop in the interest rate does. And what kind of gets me about all this is that very early monetarists, going at least as far back as Newt Wixell in the 1890s, expected to find, and Newt Wixell was very meticulous and an honest guy, did a study expecting to find a correlation between the general price level and the quantity of money. But what he found was that didn't correlate at all. What correlated was the interest rate and the general price level. Later was dubbed Gibson's paradox, and all the early monetarists knew about it. This has been forgotten, and today the dogma is if you want to cure high prices, have rising interest rates. We had a period of rising interest rates and rising and later skyrocketing consumer prices. It was the post-war period through 1981. Anyways, that's my rant, and I'll shut up now.
Well, Keith, that makes absolute sense, right? I mean, the lower rates go, right, the more borrowing happens. I mean, the cost of money, if you drive it to effectively zero, people are going to borrow. They're going to be borrowing like drunken sailors. So we are now supposedly on the other side of this of the river here, and we're going to be raising rates for the next 40 years. I think if people believe that, I got a bridge to sell.
No, hold on a second. I think that if you just look at history here, where we are at is go back to Chile, go back to Brazil, go back to Argentina, go back to the Weimar Republic. We are at the point where the only way forward is for them to just accelerate the money printing because the ship is sinking.
That's exactly right. So
in that environment, gold should be flying. Right.
So Jaime, yes. Having said that, what are your thoughts on next week? I mean, everybody's convinced the Fed's going to raise, and they're going to raise the next 2-3 meetings.
You know what? I stopped listening to the Fed so long ago. I didn't know that.
I'm just saying, every space I've been in, on CNBC, on Bloomberg, every single point of journalistic, wisdom out there is telling you that they're going to raise rates. Everybody's convinced they're going to raise rates.
Right. but 50 points is not going to do anything anyway, so it doesn't really matter. Right.
What I think the Fed is going to be mindful of is yield curve inversion, which we already kind of have, depending on which maturities you look at, and some of them are flickering in and out. But you hike the Fed funds rate another 50, you're going to suddenly have much bigger yield curve inversions and much more consistent and over every spread.
What are you inverting, though? I don't understand what you mean. Where's the inversion with the front of 50 basis points?
The Fed can hike the overnight, the Fed funds rate, but they don't really have control over the 10-year rate, the 30-year rate, even the 5 or the 2, unless they want to go and start buying those.
Am I wrong to invert it when the 10-year is sitting at 280? They have to race above 290, 280 to invert that yield curve. Well, we have a steep yield curve.
Wait a minute. They may not cause an inversion right away between the Fed funds rate and the 10-year. However, if the Fed funds rate goes up to 75 and the 2-year goes up to 3, you have an inversion between the 2-year and the 10-year.
Right, but the 2 years going. I think the 2-year and that's going to be 100% correlated with their balance sheet going through the roof because they got to manage the 2-year on the foreign, again, back to the derivatives. That's why the balance sheet hasn't gone down. They're buying up their own debt, right? They're at that point where all they can do is manage the yield curve. So when Manny dies, 1933, you can only print from this point forward, right? I think the best thing to do is just to understand that, hey, this thing is in last cycle and accelerating at the avalanche point. You got to buy right and sit tight and just wait. And
so guys, listen. This is a gold space, right? So, honestly, what do you guys think in terms of the catalyst, for gold and silver to actually move? Somebody was saying earlier we're going to see silver move before gold, and I kind of tend to agree with that because it's been suppressed for so long. Plus all of the I think it was David, who's no longer in this space. I think he said that. I mean, what do you guys think? I mean, the question I have to ask myself, I own some of these gold and silver miners, and, when they work beautifully, but the price is being suppressed. I mean, if not now, when, right? And again, I go back to, I don't know when, but what I do know is that when it does happen, it's going to blow the socks off of people. I mean, people are going to, it'll be like chasing, a rocket. I mean, it's going to be very surprising to a lot of people.
Let me say a couple of things that may be unpopular and may be counterintuitive. The first is that I've written a lot about this alleged price suppression stuff, and probably the most important piece that I wrote is called Thoughtful Disagreement with Ted Butler. So Ted Butler, wrote this piece, and he basically is taking the position of kind of this retired professor emeritus, saying, I've done my life's work, I've shown the world this, and I encourage any thoughtful disagreement. And so I wrote a piece in response to that and said, okay, I'll take you up on that. And, with data showed that at least as popularly conceptualized, the selling of futures to manipulate the price is not occurring as is commonly believed. I personally think this can has a number of kicks left in it, at least in the dollar. Now, if you're in an emerging market currency, some of those could be dropping like flies pretty soon here. But in the dollar, I don't think so. I think we've got some years left in it at this point. And you see, of course, that the dollar index rising right now, which is sort of evidence of that. One of the first signs that I would expect to see is backwardation developing either in gold or in silver or both. And right now, there's no sign of that. And I think that would be the leading indicator of a problem. So in when everything started to go over in fall of 2008, by early, I don't remember the exact date. I want to say December 7, 2008, a backwardation had developed in gold that was very significant. We've had intermittent little backwardations since then, but nothing of that magnitude. The Feb contract was something like 2.5% backwardated, 2.5% annualized. So still a relatively relatively small number in dollar terms, but huge as a percentage.
That was right after Congress passed the $600 billion bailout, right?
I don't remember the exact timing of what occurred in what order.
I have a question to that, Keith.
Let me sort of finish the thought. What the backwardation is saying. So to arbitrage a backwardation by conventional logic is risk free. So there's no credit risk involved. There's just I have a gold bar. I trade my gold bar for cash, and I buy a futures contract at the same time at a lower price, and I have the cash sitting in my account. There's nothing that can go wrong. Of course, everybody in the gold space knows there is one thing that can go wrong, and that is the whole system could default, and that paper futures contract you have may never actually deliver the gold bar. And if the whole system is collapsing and the dollar is collapsing, that's the worst thing you could possibly do, is give up your gold in order to pick up a few pennies in front of the steamroller. So when there's a backwardation developing, especially if it's significant and spreading beyond the first, beyond the near month contract, it indicates a drop or collapse in trust in the counterparty, which is the banking system. And that was acute in December of 2008. That does not occur today. We don't see that in the market today. Now, that doesn't mean, to someone else said, that could happen by tomorrow morning. It could happen on Monday. There's no way to predict when that starts to occur. All we can say is right now it isn't occurring, and until it starts to occur, I would be a little bit more sanguine about the timing of all this in the U.S. in the dollar. I just don't think we're there yet. I think it's coming, but I think that can has a lot more, or at least several more kicks left in it before we get to that point. And then somebody had a question, so let me pause
Keith,
here.
one of the things, that's what you just said is spot on in terms of like knowing when something is going to occur. No one knows when anything's going to occur, right? But you have to be there in order to participate in it. And it brings me to, 2006 and the story of John Paulson and his fund loading up on the behest of Pellegrini, his analyst that he hired, loading up on mortgage CDS. And, it didn't work until it worked. And when it worked so beautifully that he became a billionaire. I mean, it literally, everybody laughed in his face, right? Everybody. They couldn't sell him enough. He couldn't buy enough. And, we know how that turned out. So this thing with gold, silver, all this stuff. I mean, Paulson didn't know when it was going to happen, or even if it was going to happen. He just knew that if it did happen and he had it's going to pay out handsomely, right? And enough people. So one would have argued in 2006 and 2007 that Paulson's an idiot, right? And they did. That's why they sold it to him, right? So again, people may call out the gold bugs as idiots. They may tell people like like me. I've had a lot of people tell me. A lot of my friends are like into crypto. Oh, you're a gold bug. You're a silver bug. You got to get into crypto, And so you can have people tell you this, and I really don't care. It's like water off a duck's back. I just know that when it works, it's going to work beautifully. I've seen it in the past. I've seen it. I've seen the results of it in our strategy. It is somewhat discouraging when you have what has been going on for the last 12 years and effectively what has happened in the last 3 years, right, with all this money printing for COVID and everything else, I mean, we've accelerated it like a spaceship. So gold and silver should be acting better. They are not. But I firmly believe that they will. And when, I'm not sure. But again, I look at, I go back to, other times in history when Soros broke the Bank of England, right? Paulson's bet against the mortgage market. I mean, there's many of these instances in history where, the guys that really made out like bandits, people pointed fingers and said, hey, those guys are fools. They're the bag holders, they're the fools. And they turned out to be right. They didn't give up. They just stuck with it. And it's all about sizing appropriately, right? That's really the key.
So let me ask a question here. So if we're talking about, the big shitstorm to come, are we talking about what asset to buy to make more dollars, i.e. the system holds together, but there's a shitstorm and a lot of people are laid off and there's a lot of maybe inflation, calamity, whatever, but the system still holds together. And so everybody's interested in whatever trade is going to generate the most dollars. Or are we talking about the collapse of the dollar system itself, likely the collapse of the government, potentially the collapse of civilization? It's that latter that I'm thinking about.
Yeah.
And counterintuitively, I think one of the early signs that that's coming is when the gold community stops thinking about the value of gold in dollar terms, as nobody would think of the value of gold in Zimbabwe dollar terms. Nobody would say, I have 10 to the 32 Zimbabwe dollars worth of gold. And it went up, it used to be 10 to the 31 Zimbabwe dollars.
Right.
Now it's 10 to the 30. Nobody would think of it in those terms. And I think that would be one of the early leading indicators.
Well, this is
versus buy some gold futures because gold will be $5,000 next year.
Sure.
And those are two totally different. One is kind of a monetary question and the other is a short to intermediate term trade question.
Sure.
And you're kind of, pointing out that you want gold to serve as a bridge to whatever the new or the next monetary system is, right, Keith?
Right.
Well, I definitely do. I mean, I think it is going to be the next monetary system, but I think a lot of these discussions.
Look what happened.
I think in a lot of these discussions, it starts out like the dollar's going to collapse and all these calamities are going to happen. But a funny thing happens along the way to the collapse, which is baby needs a new pair of shoes. Buy gold, it's going to go up, and if it's just for a trade and a 6-month thesis that the price of gold should be $3,000 by the end of the year, there's nothing wrong with that. But it's a completely different discussion as to. When the dollar itself collapses, which I believe is coming, and I'm just saying I don't think it's coming this year. And when the dollar collapses, of course, it won't matter how many dollars trade for an ounce of gold anymore. You wouldn't want those dollars, even if there was, 100 quadrillion of them, like in Zimbabwe.
I think that if I might interject, Keith, I think the problem with the way you're looking at things from a currency perspective is I don't think you're fully putting into the context of your analysis, the interconnectivity of the financial system as it sits today. Because I don't think like I said earlier, what's happening with the yen dropping and the dollar rising, think about the pressure that all those currency swaps, those derivative swaps need that stability between the two currencies blowing up. And with that, it's all going to blow up. So it doesn't matter if, I think that your analysis is more saying, okay, which one of the Titanic's next hull is going to fill up with water before it all blows up, the US dollars at the end of the hull. My approach is, continue to look at gold and silver as the lifeboat, and I just keep buying more of that seed in my lifeboat. Because, I think here's where Jesse Livermore comes in. I've always said, hold on, buy right and sit tight, because I've always said that when you look at it from a debt side, and this is about debt, so I don't look at the equity markets really to look at signals for the collapse. When you look at it from a debt side, the longer it takes, the bigger the fiscal mess, the higher gold will go when it finally goes. And we have to understand that this has been building for 50 years because we started building this debt bubble that we're in after Nixon sets up the global fiat system because of the petrodollar, which died a long time ago, and now we're watching the end. So to me, the management of the running of the ship is changing, right? And what kind of collapse are we going to have? You know, you asked, you were looking at that. I think you have to look at what happened in Venezuela, what happened in Brazil, what happened in the Soviet republics when they all came apart, right? All of this, from an economic perspective, this process always takes 2 years from the top to the bottom. I think that unraveling has already begun, and it will only get worse and worse and worse, because this isn't like 2008. In 2008, they bailed out the system by transferring all of those liabilities over to governments. Well, who's going to bail out the governments? Really, the governments are saying, okay, we got to go at it on our own, and that's what's being discussed with China and India and the rest of the world. And you know, it's hard to say the word Russia nowadays, but Russia is part of that. They're a big producer. They're the new energy, the energy king. And that's why Saudi Arabia, the United Emirates are there, Venezuela's there, right? So that structure is being set up. The question is, what currency are they going to use and when do they turn it on, right? But that new aqueduct, that new China-made SWIFT is not going to be in the dollar and the euro. So yes, it's going to go down. Right now, I think we're just watching which one is higher in relation to the other big fiats, you know, as they come down. So, and it's not going to disappear. You know, the British pound died in 1933, but it was still around for quite a long time.
Yeah, if I could jump in here, one of the things that, if you guys are looking for the sign, so to speak, if you talk about hyperinflation doesn't ever happen in good economic times. It happens when there's a depression or a recession. And I think the Fed is trying to fight the idea of any recession. And the reason why is it's somewhat simple, but you know, interest rates, we talk about the Federal Reserve hiking and lowering rates, but in reality, the Fed is just reacting to the market. If you look at the biggest elephant in the room, which is the U.S. government, the U.S. government is really the dictator of where interest rates are based on how much they need to borrow at any given time. And if the Fed is starting to step away from the punch bowl, and they think they can step away from the punch bowl, who's going to fund the government when they start going back after May, after all these the income tax receipts that typically come in after April 15th, once that starts drying up and they start coming to market with $100 million or $100 billion a month in debt, and the financial markets can't absorb that, that's a massive tightening on top of if they're actually trying to also run off their balance sheet in addition to that.
There's not going to be any runoff on balance sheet. I'm convinced of it. It's just not going to happen. You know, they're going to have to keep rolling this paper. This is what they're going to do. It's just they're constantly on this treadmill. To what Jaime said was interesting. He said someone's going to have to take over the ship, and I actually wrote about this a while back. That it's not going to happen. This idea that the U.S. dollar is going to just tank. That it's going to be it's not going to be an event. It's going to be a process. But I think what will happen, and what we saw a little glimpse of with Russia and the ruble. And Russia demanding that people transact in the ruble and backing the ruble, even if it was for a short period of time, with grams of gold, we're starting to see those kind of signs. So, in my mind, I think if China, which is arguably one of the largest economies of the world, I mean, if not larger than us currently, the only thing that China doesn't have going for them that the Western world does is a democracy, right? So, in my mind, China will never be a democracy. China, the Chinese government, Beijing, they love the control that they have, and so unless they have a civil war in China, they're going to continue this communist system for a long time. However, if they want the world to use the yuan, the free world, if you will, the democratic world, one way to do that and still be the kind of regime that they are is to back their yuan with something tangible, something that everybody understands, something that supersedes any political system, right? Something that human beings have been using for thousands of years, and that is gold, that is silver, right? So if the Chinese, wanted to kind of checkmate the U.S. and the Europeans, right? And I'm convinced that if they could slit our throat, they would.
It's funny. Let me interject there, O'Hare, for a second with something you just said. with China, when you said China, with something that they understand. The question is, who are they? Yep. They are the people that China has to buy from, right? It's not us. We're just buying shit from China. It's who's China going to be purchasing their natural resources to get their population.
China and Russia are back to back. I mean, they're literally connected at the hip, right? I mean, so when you talk about natural resources, look no further than Russia. I mean, Russia is the largest country in the world by landmass. It's a very rich country in minerals and agricultural products and timber. I mean, they have everything they need. So I'm just thinking about it in big picture terms. It would not at all surprise me when I talk about gold going up to $300 an ounce over a course of one weekend. You wake up on a Monday morning and you see gold at $2,500. And how can that happen? Well, it can happen if you have a massive collapse in the financial system. It could also happen if we get news that the yuan is going to be backed by a fractional amounts of gold, right? That way it adds.
Let me add something for everybody else.
Let me interject here.
Go ahead.
This is another one of my rants. It is not mechanically possible to retroactively declare an irredeemable currency to be gold backed. What does gold backing mean? You know, when back in the days of the gold standard,
it just means trust.
Currency.
It just means trust. Trust in their system.
No, it's more. Well, trust is necessary but not sufficient. Back in the days of the gold standard,
you're right.
Currency developed.
Efficient, but that's why gold is what backs it, right? That's what backs the trust.
No. You have to trust that the party that owes you the gold is actually good for it.
Well,
back in the days of the gold standard, every unit of currency came into existence by somebody choosing to deposit their gold and get a piece of paper in exchange for it. And that trust and therefore that deposit base grew organically over a period of centuries as you had all the right combinations of a culture that valued honesty, the rule of law.
Why couldn't you use a blockchain technology in conjunction with the gold on deposit to, because before, you're right. I mean, is there gold at Fort Knox? Is there gold at the New York Fed? Is there gold at Barclays? I mean, we don't fucking know. No one does, right? It's not like you can go out there and assay. It could be a bunch of lead painted gold. I mean, so you're right. I mean, the reality is, how can we put trust?
Just hear me out, because I'm building a thesis here. That's the first 25% of it. So everybody deposits their gold because they trust the issuer. It's a society generally that values honesty and integrity and fiscal rectitude and the rule of law. That is, if a bank ever fails to honor redemption, everybody trusts that the rule of law will take the bank down, take all the equity, take the long-term bond capital, and that depositors will be made whole at all costs. When you don't have that, then you don't get that deposit. Anyways, the bank doesn't. The business model of issuing currency is not to warehouse the gold in the basement. The idea of a blockchain kind of thing is to take the gold and put it in a warehouse and prove that it's in a warehouse. There's no business model there unless you're just trying to get fees off the depositors, which wasn't what it was historically. But anyways, we have today irredeemable currency. Currency units today were not issued upon the deposit of a fixed amount of gold. They were issued by being borrowed into existence irredeemably. So now you want to say, okay, this thing is redeemable for gold. What's going to happen is, at a fixed rate, what's going to happen is when the market decides to move against that central bank, which is not necessarily on day one. There's been a lot of banana republics. There's Switzerland declared a currency fixing regime in the opposite direction. They said we can hold our franc down against the euro, and all we have to do, we don't have to sell dollar reserves to hold our peg. All we have to do is print more francs. Their peg. Hear me out. Just let me finish this thought. And their currency peg snapped violently. They lost something like a fifth of Swiss GDP in a millisecond when it snapped. So all it becomes is a price fixing scheme. We have a central bank that says, "Trust us. We have a giant bazooka full of gold, and if you move against us, we can defend our peg." Sooner or later, the market moves against them with a sufficient force to either drain them of all their reserves, or usually they cry uncle and still keep some of the reserves and then break it. And there's absolutely zero reason to trust a central bank price fixing scheme, whether it's Banco de Banana de Republica saying that the peso is worth $1, or whether it's Putin saying that our ruble is worth 1/5,000 of an ounce of gold.
Then why should anybody own gold then? What you're saying is it's just a bedrock.
I'm saying that wait. I'm saying
now,
one should not own.
Hold on a second. The gold standard worked for 200 years. So to tell me that, you don't see it, that it's going to work, well, it worked for a long time, and then the Americans.
Yes, it did work, but there was not a dictator declaring a price fixing scheme. It worked in the way that I was describing. It was depositing. It was depositors trusting issuers to do something sound with it, not a dictator saying my ruble is worth 1/5,000th of an ounce. Why hold gold today? Because you don't trust these charlatans. If you want gold, you're not going to hold a ruble because you trust Putin will honor that's convertible to gold. If you want gold, you're going to own the gold itself. Again, that's my point.
Again, my point is that you're trying to fix the Titanic. Do you know why the gold standard was set up? Because the French at the time had done exactly what the central banks of today have done. Well, when that Titanic sunk, Isaac Newton and John Locke was the other guy. John Locke set up the gold standard because they needed to reset, because the central banks of the time fucked it all. Oops, sorry, excuse cussing. Because the central banks at the time did exactly what they're doing today, but with a printing press, not electronically. So when that ship sinks, we're going to have to rebuild. And in that rebuild, the gold will still be there. And the reason why gold, because it's the one constant that we all have when all the paper assets are gone. So to me, that's the big picture. Everything else is how the mechanics of how the car works. All I can tell you is the car moves forth because you need to trust a new car. You need to have that new vehicle for the monetary system. And I think that's what, it doesn't matter if you don't trust Putin. I know that China and anybody that needs to buy energy from Russia needs to figure out a way to do business with him without the ruble. And so backing it with gold will give it a little bit of stability in terms of setting it up. And I know that the Chinese are going to be very happy to do it that way, because maybe they don't trust the ruble, but they like the gold backing component of it. It's trust, I agree, but in relation to the environment that we're in, where everything else has blown up. The problem is that I think that it can blow up much quicker than the mechanics of what you're applying.
So I visited China right before COVID with a bunch of meetings with money managers to look at. So we have my company pays interest on gold in gold, and we're trying to move the world forward to the gold standard that way. But so I met with a bunch of money managers in Shenzhen to explore what would be the opportunity of their clients wanting to invest in what we're doing. And the reality on the ground there is nobody who has any wealth trusts the yuan. They're desperately
trust gold.
They're desperately trying to get out of the yuan. They're trying to dump the yuan and buy dollars. Gold also, but dollars primarily. It is illegal for them to do so. It is a violation of Chinese law for them to do this trade. They are risking their lives. And when you go to prison there, you could be tortured to death. It is really, truly horrible. Everybody there who has any degree of wealth is sneaking their wealth through the capital controls, risking their lives and torture to do so. And then to say, so they don't trust their own currency. They don't want to own yuan other than that the law forces them to. The thought that, well, number one, that the yuan would become the world's reserve currency when all the people behind it are have to be walled in order to be forced to use it. But I don't think those people are going to trust the Russian ruble, gold-backed otherwise or not. I agree with you, the system is failing. And a great deal of my work is to try to describe the exact mechanics of how it's failing and the mechanics of how...
Let me argue one point, though. If that was the case, we wouldn't have had $22 billion worth of energy purchases in rubles by Europeans since the war started. If you need energy,
sure we would. There's a very simple explanation for that. The Europeans are desperate for the Russian gas and the Russian oil. Russia says you have to buy rubles to remit rubles to us. Or Europe says fine, we'll buy rubles and remit the rubles to you.
But my point.
No. In order for the ruble to be worth anything, they have to choose to hold the ruble on their balance sheet, not buy it a millisecond before remitting it. So number one, oil is a dollar market. It's not a ruble market, which means that they are remitting X dollars worth of rubles in the millisecond the payment is needed.
to say that Russian oil and Saudi oil, that Russian oil is transacted in dollars from this point since March 11th, I would highly disagree because it's not.
I did not say the statement you just attributed to me. I said that it is priced in dollars, it is economically calculated in dollars, and Russia has demanded remittance in rubles. So I wrote an article recently called "Gold, the Ruble, and the Dollar Go into a Bar." And in that, I use an analogy, and I said, suppose you have a house and you've been neglecting your front lawn, and some kid comes along and says, I will mow your front lawn for you. You say, how much, kid, to do the work? He says, I want 1 box of ice cream sandwiches. Now, is the economic calculation of the value of a lawn mowing being performed in ice cream sandwiches? Absolutely not. Is he demanding remittance in ice cream sandwiches? Yes, he is. How much is a box of ice cream sandwiches? You look it up. It's about $8, which is roughly minimum wage. So you say, okay, he's basically saying, I want 1 hour of minimum wage to mow your lawn, and I want you to do me the favor because my parents don't support my ice cream eating habit. They won't buy the ice cream sandwiches for me, and I can't get to the store otherwise. I want you to do me the favor of going to the store and buying the ice cream sandwiches for me and remitting ice cream sandwiches.
But so Keith, that's the same thing with the dollar. Keith, that's the same thing you can say with the dollar. It's the same thing you can say with every fiat currency. Right, it's just it's fungible. It's a means of exchange. That's all it is.
It absolutely is. But every balance sheet in the world holds dollars on the asset side, and every major balance sheet in the world has dollars on the liability side, and that's not true for rubles.
No, of course, right? But that's because Russia didn't win the war. We did. I mean, look, the only reason the dollar is what the dollar is because of our military strength. That's really it. That's and the fact that we could tax our citizens and create a revenue source for the government. That's really it. So I would submit to you that Russian oil and gas is worth more in real terms to humanity than the U.S. fucking dollar. Right?
Well,
I mean, Germany can't power their plants. Germany can't power their plants with U.S. dollars. Poland can't power their plants with U.S. dollars. They got to power their plants with Russian fucking oil and crude and gas. I mean,
right, the dollar is.
So all I'm saying is the dollar and the ruble, they're all the same. They're all fungible. So your argument makes sense, except you could apply the same argument to the U.S. dollar. And you're right.
Right, but the difference is the preference for holding. The difference is the preference for holding dollars is very, very intense and rising. We're talking about de-dollarization in a world where the dollar is rising. The preference for the demand for dollars is increasing in this world today.
Tom, back to you.
I was gonna ask. We're as we're talking about trust and all these different currencies. I was sitting here thinking that, if China wanted to come out and say they were going to back the yuan by this as of right now, this undeclared amount of gold, right? We've all been told that China might have something nearing, and again, hearsay, but something nearing 40,000 tons of gold. So how could they actually come out and create trust in the yuan and trust in the amount of gold that they hold? Could they just come out and say we have this gold, or would there be some kind of blockchain system, as O'Hare was pointing out? What are your guys' thoughts towards that? Because obviously every one of these countries wants to have a quote unquote relatively strong currency, right?
Right. I mean, if you think about China,
no, they don't. They believe in mercantilism.
We're not the only trading partner with China. I mean, people see, for whatever reason, we are put on a pedestal, the U.S., right? Because we're the largest economy and have been for decades. But the reality is China trades with the globe. They trade with everybody. So, it won't start with the U.S. accepting yuan, right? That's not how it's going to start. It'll start with with India. It'll start with the Philippines. It will start with Indonesia. It'll start with Russia. That's what I'm saying. It's not going to start here, but the waves will come here eventually. So the minute that some other trading partners decide, you know what, we don't really want to take, and they may not have a choice. They may just effectively say, look, you can't trade with us in dollar terms. You have to trade with us in terms of yuan, and if you do, we're going to make sure that these yuan are backed by a certain amount of gold, just so that so that you feel comfortable with transacting with us.
Right, because
I mean, that's all that's going to happen.
I completely
here. It'll start somewhere else.
I agree, and I think it already started, and it did start here because we kicked the Russians out of the Western SWIFT, and by default, it's not just. That's why Saudi Arabia is behind Russia, because they are the kingpin of energy. So it would be naive not to look at the setup in 1975 when the biggest energy supplier and the biggest energy buyer decided that from this point forward, we're going to do it in dollars, because prior to the petrodollar being set up, we were in inflation nightmare because all the currencies were completely going crazy, right? There and to worry about the mechanics of the petrodollar and the U.S. dollar again, to me, we are talking too much about the mechanics in the Titanic as opposed to the new ship that's being built. Because I think it's naive not to understand that China and the rest, a lot of the emerging markets. Did you hear, that speech by Modi that he did where he said, we are fixing up the mistakes done by colonialization, talking about the British. Then you have the response by Bolsonaro, the Brazilian president, when he said, "What do you mean? We're going to continue to buy from Russia, especially when we have 15 ships bringing fertilizers to us." Right? The fact that they supply real things, not cheap debt, is what's important. That's why I think the whole discussion of worrying too much about how the dollar is going to continue, that machine, that tower is built on debt, a lot of derivatives. That if a blow up within the currency swaps between the yen and the dollar, because the dollar is going crazy, one's going up, one's going down, is extremely possible, because all those contracts are not based on just interest rate spreads, but the spread on the currency, right? Well, there goes your dollar, and there goes the strong dollar anyways, because everything's blown up. And I think it's important to understand that setup, that this is about debt. And in a world of unending liabilities, which are creating more and more inflation, which is not being priced in by gold and silver, because 80% of copper, look at copper at $4.50, 80% of silver is coming out from copper mines. Why is silver sitting at $20? That just doesn't make sense, right? So the economic fundamentals of this facade, I think that's what we got to look at, and the imbalances that are being created because of that facade. And I think when it blows up, it's going to blow up on the interest rate side, and that's exactly what's happening. It's on the interest rate side that we're seeing the blow up, right? And I think the yields continue to go, but something's going to break on the derivative side. We're not going to know it. By the way, it's funny because as we were talking, the Martina Booth just posted something on the reverse repo, and it turns out that we're up to 93 people sucking from that titty now. It was 19 back in 2019. 93 financial institutions are needing liquidity overnight right now. So those are not just Americans. Something bigger is going on, and it's got to be with the derivatives.
I was going to ask too. I know you kind of needed to go here, but I wanted to ask you earlier, and this kind of ties into what you guys were talking about all these different currencies. How do you think that countries that are commodity producers, like let's say Canada and Australia, especially that are producing gold, are going to do, let's say relative to King dollar? And when you talk about the amount of debt that these countries have as well, how does a country like Canada that holds no debt in its central bank, but yet has a ton of debt, how do they do in that situation as well?
Well, I think it's going to look at Argentina, look at Brazil, look at Latin America to answer that question. You're going to go through a massive currency devaluation. The resources are going to continue to grow in value, but that's inflation. Inflation is not that things are going up in price, it's that the currency is going down in value. The purchasing power is being lost, right? So I think that's the mechanics of what they go through. At some point, I think we have to watch the other side, because we, as selling or buying of our natural resources, we are going to have to participate within whatever currency structure is going to function through that new China SWIFT. And it's not the dollar, Keith, and it's not the euro, because Russia won't allow it. Trust me on that.
So my comment is, what currency every balance sheet in the world prefers to hold? And your answer is, what currency Russia will demand to...
worth of money.
Can I finish my sentence, please?
Mm-hmm.
You're talking about what currency Russia will demand be remitted to them to buy oil and gas. And I'm saying what currency everybody will prefer to hold on their balance sheet, which they can swap for rubles in the millisecond before the remittance to Russia. Is the world going to decide that they want to be lenders to Putin and supporting his debt and his borrowing and throw away the American dollar? And my answer is no, I don't believe that's going to be the case. I don't believe there's any other irredeemable currency that can replace the dollar. And I don't believe that any irredeemable currency can be retroactively declared to be a gold redeemable currency.
Keith, the only currency that exists is when you talk about money, currency, it's gold, right? I mean, it has been for thousands of years. I mean, I don't understand this hang up people have. Maybe we're just living in a, I mean, if Bitcoin can go to $64,000 for something that doesn't exist in the real world, it's essentially a digit on a computer screen. I call it a gambling token. If something like that can transact at 64,000 US dollars, right? Then why the fuck couldn't gold go to 5,000, 10,000? So this idea, I have a lot of friends in the Bay Area that are convinced that Bitcoin's the end all be all to all of our problems, right? And just looking at it from the wrong, I know the Bitcoiners out there, I know what they're trying to solve. The problem is it's not going to be solved with Bitcoin. It's been solved throughout history with gold. And so this idea that, we have to have a paper currency, the fiat currency, yes, we have to have it. We've had it, but we don't have to continue having it.
I'm not arguing we have to continue having it. I'm arguing there are two proposed mechanisms here for how we're going to switch, and I'm saying those mechanisms won't work. Yes, the dollar system is failing. Yes, it's going to be. The dollar system is failing, but it's not going to fail by Putin declaring the ruble to be gold backed. That's my point.
But Keith, hold on, Keith. If Putin has the energy, and he's the only guy that's going to sell it to you, if he wants to get paid in pet rocks or in shells or in cows, you're going to supply whatever you need to get that energy because you need it. If the wheat, everything, all the resources that they supply, right? So I think it's a moot point what you're saying. If I need it, I'm going to.
By the way, Jaime, here's that's a great point. Even if Germany were to turn on all their nuclear reactors and go back to nuclear power, they're going to have to get the uranium somewhere. Much of the uranium that we consume in the world for nuclear generation comes out of places in and around Russia. So it's inescapable. I mean, this idea that we're going to just kind of somehow continue the fiat dollar, the US dollar is going to be the king, forever. I mean, historically speaking, currencies have gone in and out of favor in 100 years. I mean, look, Portugal, Spain, France, England,
remember when Bernanke?
This is not you. You guys all know this. I mean,
I agree. It's funny because Bernanke once referred to gold as they asked him. So Ron Paul's asking him, so why do we hold it? And he goes, it's because it's tradition. Well, my mom was Jewish. I understand what tradition means for money. It's monetary tradition, meaning that it's been around for 4,000 years. Right? That's what he meant. That's why we have it. It's tradition. It's what we always fall back on. When everything falls apart.
I would even go further than just tradition, because tradition is, it's.
I'm going to have to run. I'm going to have to bow out. Take care, everybody, and have a good evening.
Keith, good talking.
Jaime, take care. Bye-bye.
Tradition is a part of it, but tradition only goes so far. It's the qualities of gold, right? The qualities. Right, the malleability, the fungibility of gold, the usefulness of gold, the fact that it doesn't rot. It's all those properties of gold, and the fact that it's extremely rare. Right,
you can't it comes back to trust, right?
And it can't be duplicated.
That's exactly right.
Yeah, which is it's funny because I own blockchain, I own Bitcoin, I own Ethereum, but I know that the big money is going to come. The next big move is going to come from gold and silver as they unpeg as they finally emancipate. We're always talking about slavery. The massive slavery of the price of gold is what is the big thing, especially when you look at inflation and everything else. It's the only thing that needs to go. Anyways, it's been fun, and I really have to go now.
I got to hop too. Hey guys, great talking. Palisades, fantastic space, man. We need to do more of these. You get out there and educate people on this space. I mean, I think more people need to listen,
Absolutely. Yeah. And I really appreciate both of you guys' input and time. It's been great to have both of your thoughts on all these different subjects. Thanks so much, guys.
If I can kind of post a little bit of a wrap up to what they were kind of talking about, if everybody in this room, in the Spaces room that you provided for us tonight, Tom, they can, if they choose, they can be on their own gold or substitute silver standard if they want to. All they got to do is call Bob's company, and Bob's company offers great product at low markups, and you can convert as much of your fiat money to gold. Or silver is 83 to 1 now. The gold silver ratio is 83.5 to 1 as of today. If you think silver's cheaper, he's got silver. And it's not for all of your money, because people need money. Like they were talking, the two guys, Keith and I don't remember the other guy's name, but they were talking, you need a certain amount of fiat to transact business with your grocer, your meat market, your gas station, that kind of thing. But for your savings or for your wealth protection, everybody can decide to do it. And probably everybody in this room tonight knows that already. But I think that the factor is that when it's 83.5 to 1 gold silver ratio, silver gets to be more attractive when and if, or not if, but when it does move. And we've seen it. There seems to be a historical average between 30 and 40 to 1, but it could be 15 or 20 to 1. I think it should be 30 to 1 today, but that's my own opinion.
One thing it's also important to note, because I look at how the market's structured. I look at some of these, the building blocks or the foundation of how you determine price, or how you determine if an asset becomes, a network effect, or starts to take, popularity, that type of thing. With silver, it's interesting because with silver, even like with Silver Eagles, there's ways that you can actually make silver more usable as money, where we're not trading per se in dollar terms, but just basically in ounces. And that's part of that's actually creating some type of national exchange where you have a more of a two-way traded market, more transparency in price and that type of thing. But it will also allow you to create a structure or network where merchants can use or take silver, for example, and then have a place to deliver it to settle, some type of, to settle that trade. And you could create a network of custodians or depositories around the country where basically just like dollars are collected at the grocery store and, in an armored truck and taken to a vault. Same thing could happen with silver. Obviously, it's a lot heavier, but there are ways to create this type of imagery that would start to promote silver not as necessarily a dollar alternative, but actually as, like Bitcoin does, as, some of these digital gold and silver programs are doing, just by doing it on a digital basis. I think that would be extremely helpful, and it starts to bring the public, more aware of what's, what the metal is, because everyone's kind of disconnected because you don't really see it in stores. You just, it's basically kind of known to be put in sock drawers.
So Bob, why silver? Because you could buy, like you're saying, smaller quantities of items with it, and it would be more, let's say, usable for everyday purchases rather than big purchases.
Well, I mean,
logistically, I'm just thinking about, like you said, transporting a bunch of silver for an average store would be kind of a pain in the ass, right?
Yeah, no question about it. It would be, we'd be, I'm not saying that everyone's going to just take their silver down and start buying, cereal boxes with it, but the idea of the ability to use, like, because people don't understand or may not be aware, but between 2011 and 2013, there was a lot more silver bought then in like Silver Eagles, for example, than there are now. And there's a lot of overhang that's in this market. And so, but what the interesting thing about Silver Eagles is it's legal tender. I mean, it can, not that someone's going to spend it for $1 in the grocery store, but if you can create some type of pricing structure that allows the merchant to have convertibility, and by doing that, you create a, just like a national exchange for that type of system where they can take down, they see the price on a TV screen or on a computer somewhere. It's a publicly traded price. It's just like the COMEX, but it's in physical products. It's a bid offer system. You can sell to the highest bidder. You can buy from the lowest offer. We don't have that in our market. It's a dealer-driven model, and which is very frustrating for the public because there's not a lot of price transparency. I think it would just be very helpful to have a better trading mechanism to recognize actual true value or true price, because the public, I think, would be they'll be more apt if they have the ability to buy, on an exchange versus a dealer, and not knowing where to sell that price or where the selling price is going to be the moment they take it out of that dealer store or take delivery from an online dealer, whatever it may be. Having some type of transparent exchange would, I think, promote usability as well as, because that's something that, it was a great conversation earlier, but one of the things that I've noticed, like with the Russian ruble, is that if it's used only for that split moment, second, to convert it from euros into rubles, and then to convert that back into oil or gas as an exchange, why is the ruble been on a tear lately? I mean, it's it's well below its pre-Ukrainian invasion price, and so if it's just used for that split second, I wouldn't think that the market would give 2 cents whether the ruble's at 80 or 100 to 1, where it gravitated when they announced that 5,000 ruble to a gram idea. This thing is trading back down, I think 72 to 1 now. I mean, it's not just like it's being sold back onto the open market as soon as someone gravitates and gets it. So there is something for creating some type of gold back standard in a currency. But one thing I was going to mention is you don't necessarily.
Sorry, before you move on a sec there, is it possible though that there's not enough liquidity in the ruble market, and that demand for buying and making those transactions at this point is creating enough demand in that market to keep the price where it is at this point?
Yeah, I mean, you could say it's a much smaller market, and the ruble is basically being gobbled up and then sent over to the Russian bank. And the question, I guess, really is the Russian bank distributing those rubles back out into the market again, or buying rubles, or buying, for example, Chinese goods with rubles, and so then China has the hot potato, and then how do they turn those rubles back into that's how ideas form, and that's how potentially currencies can grow. But if the ruble is basically just given back to Russia and nobody accepts the ruble, except they just demand payment in rubles, what will ultimately happen is the ruble will get so strong that there won't be any rubles left to buy because it's not being circulated. So that's why I think it was a great point earlier, is that the dollar, I guess, de-dollarization, I guess you could call it, will happen when other countries start to just basically say, hey, listen, let's just trade between each other and let's bypass the dollar altogether. That's where I see these trade agreements spawning that type of process, because obviously what we did with Russia's central bank reserves, which obviously put everybody on alert that says these aren't your reserves anymore, it's our reserves. The other thing I was going to mention too, it was talked about earlier, the reverse repurchase program that Daniel D. Martina Booth, I think, posted on a tweet. She was talking about 92 participants now have a total of 1.907 trillion that are lending that to the Federal Reserve in that reverse repurchase program. which at the end of December, that program was 1.905 trillion. I think it's worth it to note that that program is kind of telling of the confidence that these participants have in financial instruments at this point, or securities or bonds or debt, is that those participants of money market funds, pensions, whatever it may be, that is lending money to the Fed at a stated rate, a return, instead of buying treasuries or buying corporate paper or any type of short-term or even stocks, whatever it may be, is the confidence that those prices, that interest rates may go higher, and the effect that those instruments may go lower in price. They're more apt to say, listen, I'd rather loan it to the Fed and take that type of risk-free return than stick it into the financial system. Because I think at the end of December, I think a lot of us were looking for the reverse repurchase program to start unwinding. And for those that aren't aware of this reverse repurchase program, basically, it kind of started back in February of last year when the bond market was breaking down, and then the U.S. Treasury came out and said, listen, with the remaining cash that we have, we're just going to buy back U.S. T-bills, and we're going to basically redeem those T-bills and give it back to the participants that own these T-bills. So what ended up happening was money markets and pensions and municipals, anyone who had T-bills at the time, basically were redeemed. And instead of going into the market and trying to find more T-bills, because there was a limited amount of T-bills out there, what has sent rates negative, the Fed created this reverse repurchase program that says, listen, you give us your money and we'll basically borrow it from you and pay you a stated rate of return. So that program basically went very correlated with the amount of U.S. T-bills that were redeemed by the U.S. government. That money went straight to the Fed. And so, and that built up that reverse repurchase program to the tune of $1.9 trillion. Well, fast forward to the end of December, a lot of people thought that money was going to start coming back into the market, and that would be a supportive factor in fixed income. It may keep rates near zero. It may keep the stock market near all-time highs. It would stabilize the system because that money ultimately would come back. Well, it hasn't. And that's, I think, surprised a lot of people. And the question you have to ask is, why hasn't that done that? And it may be the fact that people may be expecting the Fed to continue raising rates, but when you raise rates with the Fed on this program, you're just getting a stated rate of return that increases when they raise rates. Whereas in treasuries, if they raise rates, the value of that treasury may go down in price, which may, if you're using some of this stuff as collateral, becomes potentially at a loss if interest rates rise too fast. So there's some structural dynamics here that are going on that actually are concerning. That, hey, listen, the Fed may not be. They may try to actually be, we may be underestimating the Fed's resolve of raising rates, or don't say raising rates, because all they're doing by raising rates is just simply catching up with the market. It's really the idea of them reducing their balance sheet, and the balance sheet runoff that may occur. That's the damage that could really hammer the markets. And I think that's where they may try to do that. I mean, it would be, I think, somewhat financial suicide in a way, because they are the market. I mean, they basically funded it all the way up, and they're going to try and think that they can defund it and have the market stay at some sort of level price. And I understand they got to control inflation, because the inflation, if it's not controlled, can become a destabilizing factor as well. That's what we were talking about the last week at the last spaces, where with Bitcoin and so forth, was the idea. A lot of people don't think the Fed's going to actually go through with any type of tightening. Well, I think the question is, have they been warning us and telling us, and we're just basically thinking it's the boy who cried wolf syndrome, and no one believes them. But and that could create quite a destabilization in the financial markets. I mean, we'll see next week, obviously, because it's not necessarily the interest rate move that the market will be watching. It'll be their commentary and their idea of the balance sheet runoff that everyone will really be watching at that point. and the precious metals on this big pullback that we've been seeing, this whether it's deleveraging in some of these in the futures market or other types of structured products, whatever it may be, but the metals could be signaling, just like it did in, I think, July or August of 2008, right before Lehman went down, is it could be sensing that the Fed may actually be trying to tighten and surprise the market. And then, of course, the market could break on that. And I think at that point, the Fed may have to curtail, whatever their strategy is if the market breaks low enough. And I think that's what the metals, that's what we're all watching for, is at some point that break in the market will force the Fed to stop. And then ultimately, in order to revert recession, they're going to have to come back in and fund the markets again, or create QE and support the treasury market, because the tax revenue base will start to decline, and it creates this rolling effect that the housing market will be impacted and so on. This is, I think, where we're at. I mean, we're at a much dire point right now that really needs the adrenaline rush of QE more than ever, because we financialized everything. And that's the worry that when you financialize everything and we're heavily indebted, these interest rate moves up have a greater compounding effect.
Yeah, I think that was a great point, Bob, about basically the demand coming for those reverse repos and wanting that as you said, that risk-free return. Yeah,
it's just, you try to watch and I can't say it enough. I mean, Lee Adler does a great job of following the liquidity, following the Fed, really analyzing the Fed's balance sheet. He's a great follow, but these are the things you have to kind of keep an eye on, because this is somewhat the fundamentals of the market. You have the primary dealer system, which, one thing that was touched upon earlier was bank balance sheets. What people don't understand is the bank balance sheets, the treasuries that they own, they don't mark to market those treasuries. It's held at book value or par value. And the primary dealer system, for example, with the interest rates going up as much as they have, since August of 2020, there is a lot of damage that has been done in price to any one of these institutions that have been holding treasuries ever since the 2020 timeframe. And that's, of course, when banks went heavily long into treasuries at the time because of some of the regulatory relief that they were provided by buying treasuries. But these are the mechanics of the market. I mean, these are the things you have to watch for, because sometimes you do get forced selling in the market, just like gold and silver. I mean, it happens to every asset out there that you may not want to sell, but if you're unleveraged, you're forced to. You have no choice. And I think that's what we're seeing right now in the market. And that's why, some of these structured programs that have borrow against your gold and silver, and you probably had a lot of people that were very confident metals were going to go higher, but instead of selling the metals, they took a loan out against their holdings. And the sizable move that we've had, I mean, if you were 80% loan to value, for example, a month ago with gold and silver, and you've seen this drop here, the dealer or the structured program is going to start, they're probably close to, calling in some capital to maintain that loan exposure. Otherwise, you're going to be forced to sell your metal. And we've seen this before in the past where I think 2016, where you had, or 2017, you had a shot down in the market, and one of the big loan programs had, I think 25% of their entire program got liquidated on that move down. So those are just things that I watch for.
Yeah, that's really important to understand those differences, and we're absolutely going to have to get Lee on one. We'll just have to do it much earlier in the day so he can be a part of it there. Bob, we had a question come in a little while ago, but maybe you can give us your thoughts on it. What process do you think a country could use in these times to set up a viable gold standard? Surely it would require winding down the existing currency rather than backing the existing one in order to avoid a run on the banks, possibly internationally as well as domestically.
Well, there's a couple different ways to do it. I mean, Jim Sinclair, I remember when I was following him, must have been back in the mid 2000s. And one of the things he said back then was at I think it was at the American Stock Exchange conference or something like that. And he was the guest speaker, and he was talking about how he called the gold market in the 70s and came up with that $850 an ounce price, I think it was. And he basically took the U.S. Treasury debt that was owned by foreigners and used the price of gold on a per ounce basis and against how many ounces the Treasury had at the time to how much foreign owned debt there was, and obviously convert that into a price. And it just so happened that around $800 or $850 an ounce was the magic number of what the dollar price to how many ounces the Treasury had. That was enough to back the Treasury supply that was owned by foreigners. And that the reason he brought that up was it was a confidence game that said to foreign owners that says, listen, we're so confident in our debt that we have this amount of gold on our balance sheet to back it. And so you don't necessarily need a gold standard on a dollar for dollar basis, as you may need. You could do that through your bond market as well. Of course, the bond market's huge. But like, I think, some of the players out there like Rickards and some others, tend to say is that, gold, the price of gold is all relative. You could simply increase the price tomorrow to match whatever balance sheet item you need matched, because gold is really used in today's world as a neutral reserve asset. It's not really used as an anchor for, the total value of gold held on a balance sheet to the total number of dollars created. It's really more of an anchor to a balance sheet. So from that perspective, that's how I would see some type of hybrid standard come out, which doesn't mean that you have to uproot the dollar altogether. You just have to provide enough stability in the system to, that gives people confidence that the government's balance sheet itself isn't just full of hot air. And that's why we all look at these. That's one of the reasons why we all look at the tonnage that the central banks as well as governments hold on their balance sheets in terms of gold. It's for us, it's more of a confidence game, and that's probably the reason why central banks around the world have been repatriating their gold or buying more gold, especially over the last eight or so years. They've been net buyers, and while they've been net sellers of U.S. Treasuries, is that they want the appearance of their own citizens, that appearance of stability, and I think gold has that edge. We talk about tradition, but it's also something that's globally recognized as well. I mean, gold actually has the ultimate network effect as well as silver. I mean, silver technically has been, David Morgan will tell you, silver's been money longer than gold has. So you actually have probably the most decentralized system in the world in physical metal. And that's why one of the reasons I talk about delivery so much, because it's the physical delivery that's really the Achilles heel of the entire system. The moment that everyone starts to demand delivery, this system will crack. And that includes a lot of popular allocated and pooled programs out there that, people have invested in thinking, okay, I'm going to buy my insurance policy and I'll store it with XYZ company, or I'll put it with this program that says I don't have to pay a storage fee, yet I can get it at any time I want. Well, the moment you see like what happened in 2021 and you see demands for delivery start to come in, and there wasn't even that much demand for delivery. It was enough just to kind of literally overwhelm the system at the time. But imagine if you had 10% of the entire program ask for delivery tomorrow, it would cripple any system out there. I would actually just tell people that if they have, any type of storage program or any type of professional structured program, call the program up and say, what's the process to take delivery if I want to take it? And have me walk through all the steps. You'll be kind of surprised. It's not something that you'll get, tomorrow in the mail. It's quite a bit of process.
One other thing, Tom and Bob, that you read once in a while that people in the know advocate to measure your wealth in ounces, not in dollars.
Yeah, that's a great point, Jim. And I mean, the other part of that question that I was going to add there after too, Bob, was I mean, obviously, we can totally say that you're going to have a biased answer here, but his main concern was kind of, getting basically, we had kind of made that point earlier about, is gold maybe the best bridge through that currency shift, whatever that looks like, to preserve the purchasing power or the value of your, labor that you've saved and invested into gold or whatever asset that is at this point.
Yeah, I mean, that's what I keep, and I've mentioned this before, but I come from this market from the financial side of the business. I've been an investment advisor and been in the business for 30 years. And so I come at this looking at it from a store of value standpoint. To me, gold is not always the greatest thing to own. There's certain times to own it. And it is, I think, the bridge between point A and point B, that uncertainty, that's why we buy it. We buy it when government becomes too indebted, becomes, you have political instability. You have, the idea that all this debt's going to ultimately create more or the need for inflation, the need for more money printing. I mean, that's why we want to own an asset. Now, I mean, it just happens to be a hard asset that's been around for a long, long time. I mean, it could be, like we've seen used cars. You could have it, bedpans, for example. I mean, it could be any type of hard asset. It's just that gold is one of the few financial assets that's hoardable. I mean, you can store it and not have to worry about corrosion and all the other good stuff that comes along with, whether it be monetary controls or just simply decay. But at some point, if the government wants to instill stability again, let's just say, we don't have an aggressive revolution in this country. We come to our minds, let's say, it's going to take some type of major event to have that happen. And you have some type of collapse in the system. And just like how our country was founded by some pretty smart guys a long time ago, 1700s. I mean, you could have a similar meeting of the minds, and you could say, listen, we have this asset. We could call in gold, not necessarily from the public, because the public really doesn't have much gold anymore, but they could buy it or, do the force majeure thing where they could take delivery from ETFs and go through the force majeure contract and cash settle, therefore use that to strengthen the balance sheet. I mean, there's different ways to do it, but once the government has some type of standard, whether, not just a, purely fiat standard anymore, but something that actually has some tangible effect to it and provides an anchor, there's not as much need to own gold anymore, because it's not that's if we get to the point of complete stability. Of course, it would take a lot for that to happen, because obviously, you would need a devastating effect. But let's just say, for example, the Dow Jones market or the S&P 500 collapses 80%, like it's done in the past after different melt-ups, like 29 or 19, after the 1970s bear market, where you had the Dow and gold literally on a one-to-one basis, or 1933, where you had gold and the Dow at a one-to-one basis. I mean, what if gold becomes overvalued back to the stock market again on a relative value basis? It may be more beneficial to go back into the stock market. Now, the question is, what will the country look like at that point? But, I don't think any of us are hoping that the dollar goes to zero. I think that would be a nightmare if that occurred. But I think we got to have enough resolve. There's a lot of smart people in this country that they'll use gold as some type of a neutral reserve asset to anchor the balance sheet at some point, to try and hit the brakes and stem the bleeding. And then, of course, it'll require some overhaul. But yeah, it's either that or this whole thing just comes collapsing down. And if that's the case, that's why I keep advocating take delivery of your metal.
Yeah, I know that point has been made quite often, is that we all want to see gold at $15,000, but if that comes at the cost of the dollar being completely destroyed, you don't necessarily want to live in that world, right, Bob?
No, it's one of those things that, what are you going to spend your gold or silver on at that point? Because there's going to be nothing in the store to buy with. I mean, you see that in hyperinflation scenarios where And a lot of people say, well, I'll own real estate. Well, yeah, and the Weimar days, landlords that had rented out, their apartments and homes and things like that for income, during that hyperinflation, people were just ripping the stuff right out of the house, fixtures and so forth, because that was worth more than the currency at that point. So everything's relative. And then, obviously, we talk about, that's why interest rates are so important to watch in a very financialized economy. And that's why the Fed can only allow interest rates to rise so much. It may not be the stock market per se that is sort of the Fed put. It may be the level of rates is really what they're focusing on. And they're willing to have the stock market pull back further in price in an attempt to try and quell the inflation. So at some point they can keep the system going. Or the moment the U.S. government can't fund itself anymore, we got problems. And that's where interest rates go through the roof, irregardless of what the Fed wants. And at that point, the market determines the rates.
Yeah, it's just there's so many different, everything seems to be at odds here with the Fed's dual mandate, right?
Yeah, I mean, I think the big question or the big difference we have in today's world than over the last 40 years has been the inflation theme. They really have overdone it on the monetary side. They've used the word, using transparency and some of this Fed speak the last year and a half, basically making a fool of themselves. They're now at a point where they have to pull back on the throttle. I don't think they have a choice. And they're trying to figure out, I think, again, like I said earlier, they're hoping the market does some of the dirty work for them, and some of that kills some of these commodity prices. But I think as investors are waking up, and a lot of smart players are out there looking at these, relative charts on the S&P 500 relative to commodity prices, and you see these 100-year charts, and you have commodity prices right at a massive trough where it's happened 3 times prior, in the last 50 or 70 years, and it's been a great buy sign. I think a lot more hedge fund managers, a lot more money managers out there, a lot more investors are recognizing that, hey, wait a second, commodities may be the place to be. And that's, that we talked about this, I think, in the first spaces, was the idea that, instead of the dollar, our dollar, your problem, it's now, like Russia says, our commodity, your problem. And, we may be, I think we're going into the age where paper currencies may be losing its momentum, and it's showing, like with the yen blowing up, the euro kind of breaking down. Eventually at some point, the dollar is just going up relative to the other currencies. The question at some point is, what happens if those dollars start to flood into commodities at some point? After this sell-off, after this sort of, I think this is just a massive shakeout right now. I don't think people are looking at commodities and saying, oh my God, the Fed's going to raise rates, the commodities are going to break back down, and we're going to go into recession. I think that the idea of a true recession and a complete depression, it's hard to have that initially when you have a printing press and a fiat system. It'll have to be that the ultimate washout will only come when the currency is dropping like a rock, and they can't, at that point, they don't have any more tools left in the toolbox. I mean, at that point, they have to raise rates. And how do you raise rates when you have, $30 trillion in debt?
So, Bob, what do you think of the idea that the Fed, you kind of raised the point that you're hoping that the market does some of the dirty work to kill inflation for them, but the Fed doesn't really have control, or doesn't have control over commodity prices, and that's where we're seeing, let's say, the basis for a lot of the inflation that we're seeing at this point. And it seems like the Fed, their only tool is to raise rates and, in some ways run down their balance sheet. And that doesn't seem, or it's not a direct, let's say, tool to be able to affect the type of inflation that we're seeing, right?
Yeah, it's 2 good points. The supply side of the picture, the central banks really don't have control over. I mean, that the supply destruction or the ability to get commodities, if they could raise rates to or lower rates as much as they want, if you can't get that gold or that ore out of the ground, or the nickel or whatever it may be, monetary policy isn't going to change that. But I think what they're hoping is by tightening monetary policy, the way the world currently works is it's very highly leveraged. It's very highly financialized. And their hope is that if they tighten policy enough, the leverage that's in the system will tighten up and actually deleverage. And that'll bring prices down, maybe on the paper side. And people recognize that and say, okay, well, prices are crashing. I'm not going to hoard oil, or I'm not going to hoard corn or whatever it may be, or gold or silver, because the prices are crashing. But I think the trick is that investors are saying, well, wait a second, that's just a paper price. You still have supply destruction or supply issues that tells me I'm not going to be able to get that that commodity that very easily, even if the paper price is coming down. And then all of a sudden now they've lowered paper prices. So now, like we all watch on the COMEX, you can buy silver at a cheaper price based on the spot price or the price on the COMEX. What's happening is physical players are coming and buying more metal. They're saying they're not trusting that the Fed is going to be successful in pulling back the throttle, because they know that at the end of the day, housing prices and interest rates and fixed income and the stock market, the wealth effect, is if they lose that, they lose a complete destabilizing effect. That they lose the social order of the system, and that's where you start to build the social chaos theory, and you start to get the instability, people starting to pull back from spending in the economy, and at that point they typically they'll increase their hoarding of hard assets or just cash. They'll start just hold on to it rather than spend it, and that has an economic loop to it where you continue to contract.
Yeah, and that's really the wealth effect that you're talking about. And it's been brought up on the show before that the Fed is far more scared of the negative wealth effect than the positive wealth effect that the market is creating. Do you see that the same way?
No question. I mean, they've highly financialized the economy so much over the last 30 years. I mean, you look at, ever since 87, Greenspan came on, and they went down this slippery slope of saying, hey, listen, every type of event that happens that's a negative event, we'll come in and start to stimulate or provide money supply, or we'll do something that provides liquidity to the system. And that has gotten to such a large degree at this point. I know it's talked about ad nauseum, like long-term capital. Wall Street bailed out long-term capital. 2000 was basically, 2000 was the tech boom, but a lot of retail players got creamed during that time frame. But the 2008 scenario, Wall Street got bailed out by the governments, and then of course you had the COVID thing, 2020, where basically at that point, or actually you could almost go back to 2018, where the governments were failing and central banks started to bail out those governments. Well, the problem you have now is the central banks, there's nobody big enough to bail them out, and that's where this idea of interest rates can only go up so much, because these central banks have all this debt on their balance sheet now. I know it's talked about a lot about the debt jubilee idea, or the idea that the debt's just going to be written off, but that all these things have these two-tier effects off of it, and to me it's a confidence effect, and that's where I think the physical metals, I hate to say it, but I mean, gold's seen this before in history. I mean, you've seen the French, the empire, the Spain, and all the British Empire, and all these empires come and go, and yet you see the gold coins at the bottom of the Atlantic Ocean are still worth a lot of money. In fact, they've gone up in value. Gold will hold through these temporary times. It's these governments now are trying to figure out, how do we create stability, even though the numbers are just getting too large.
So what you're saying is, Bob, is that everybody who's had a boating accident, all of their coins are now worth more?
Yep.
Well, not after this week, they're not worth more. Actually, this week in gold, they're worth more, but the silver coins are worth less.
Yeah. The silver, the oddity is the premiums on some of these products continue to be very, very high, even on the wholesale level.
It's crazy. You're doing a good job, Bob. You're being reasonable. A lot of the other guys, I realize that there's 2 or 3 profits involved over the price, over the spot price. There's a jobber price, there's a retail price, and then the mint's got to make a little something too. I realize that, but when you're $12, $14, $16 over, that's nuts.
Yeah, that's part of the problem that the industry has. It's kind of stuck right now because it's it's the effects of the last 10 years, and it's really the effect of the last 20 years of the public just saying, you know what, gold hasn't done anything, or at least since 2011 hasn't done anything. I don't get inspired by it. And then you've had the refiners, some of these big refiners go under, and so there's a lot less supply out there. I mean, we've seen supply destruction in our own industry and the effects of that. And I know there's a lot of smart guys that look at the effect of food and energy and some of these other industries that are seeing similar destructive effects as well. And that's why the supply side can't be massaged with monetary policy, because at the end of the day, we all are kind of watching the Fed and we're all saying to them, okay, how much are you going to really raise before everything blows up? And then you're going to have complete instability. I mean, we're all, that's why, it's amazing how they've been able to keep this game going for as long as they have. But yeah, it's frustrating. That's why I think a national exchange, something of that nature, where you have more of a transparent market for physical product, where there's a sort of a maybe narrower spread, kind of like where you trade stocks at. But you can at least, the client or the customer or the public knows when they buy metal at a stated price that they have an idea of what the cost is going to be when they sell it. That's why I keep telling clients, be very careful overpaying for metal, because if the price does go up, you're going to get a lot of people selling back, at $45 silver or whatever it may be, because there's a lot of people that bought silver, in 2011, 12, 13, that bought it in the 30s or even in the 40s. And they're saying to themselves, my God, I've been sitting on this thing for 12 years. If it gets back up to 45, I'm out. And you're gonna get some secondary selling starting to come into the market. Even though you're going to get a lot of people coming into the market, that secondary selling could be enough to start driving premiums down. And that's something that you want to be kind of careful of as an investor, because you don't want to lose premium. You don't want to go and buy a product with too high a premium.
One other thing I'd like to mention, you were talking a few moments ago, Bob, about the commodities. Really, gold and silver, nobody's going to take delivery of copper, but gold and silver, later, an investor can actually take delivery. A gold contract's a 100-ounce contract. A 100-ounce bar is no big deal. Silver is a 1,000-ounce contract, 5 bars, 1,000 ounces. You can take delivery of that. They probably weigh 75 pounds apiece, 80 pounds apiece, something like that. So the John Q. Public can actually take delivery of gold or silver. They're not going to take delivery of crude oil. They're not going to take delivery of live cattle. They're not going to take delivery of 5,000 bushels of corn or wheat or soybeans. So that is one instance where the business you're in, the public can actually take delivery if they choose to, or make delivery. That's the other thing. COMEX is a two-way street. Maybe people don't realize that, but you can make delivery, and that's what mines do. They don't necessarily make delivery themselves. They use a contracted source called a bullion bank. But I just wanted to make sure that people were aware that COMEX gold and COMEX silver are deliverable, and you could take delivery and put them in your safe very easily. Thanks.
Yeah, no question. And that's where I think in 2021, after the silver squeeze kind of came into play, and basically just premiums went up across the board. Guys like me came in and started buying 1,000-ounce bars, and taking them right off the COMEX, taking metal that was dedicated to the COMEX, just taking that as well. But looking for more efficient prices of metal, knowing that, just as much as the retail guys buying metal, because we all believe silver is undervalued. I mean, especially relative on a longer term basis. You look at the return of silver since 1971 and how it's relative to the S&P 500. It's underperformed the S&P 500 and gold almost on a 3-to-1 basis. So silver would have to be about $65 an ounce in today's world to be relatively valued to how much growth the S&P 500 has had. But the more important thing is understanding. If you can understand how to take delivery, it's not a very difficult thing. I mean, you do it. Jim can help with anyone that wants to get involved with that. I mean, it's very doable. Or you call guys like, they're dealers that will buy 1,000-ounce bars and sell them to the public. Those. It's just a different form of metal. But I'm telling you, once people start taking, it's like the institutional crowd. I talk to some institutions, a lot, and high net worth investors. Then they go, well, we don't want to. We're not interested in buying physical metal. We'd rather just buy SLV or some other type of derivative because it's easy. But they don't really actually understand how easy it is to take physical delivery, especially when you have a company like myself, or there's other companies out there that have the logistics in place, have the insurance policies, have the freight policies, have the armored policies, where we can move product out of the vaults over there and put it outside the financial system. Because of the bigger worry that I think a lot of people have is, what does, gold and silver may go up in price, but what does the world going to look like when that happens? And I think that's where a lot of these higher net worth individuals are starting to realize that, well, wait a second, my SLV doesn't really solve the question of tax policy or monetary controls, or any type of, like a Trudeau type of event where they just shut down an account altogether. They can't necessarily do that with physical metal. So you're seeing larger players the last few years starting to understand the need for physical. It's just an event that needs to take place to get people to understand. It's actually a fairly easy process, and it's actually pretty efficient too. I mean, it's actually cheaper in a lot of instances to buy the metal and even have it stored professionally than to pay some of these storage or some of these managerial fees, to some of these ETFs and so forth. I don't know if anybody has any questions.
Yeah, I was just going to say, do we want to take some questions if anybody has some? I guess we don't really have any questions. We pretty much went through. We kind of touched on all the questions that were DM'd to me or sent to me during the space. We CDCA, you need to be able to speak if you have a question.
Could I ask one question for Bob?
Of course, Jim.
Could Bob give everybody his phone number that's listening here tonight, in case some of those people might want to use him as a source for metals? I think that's a great idea. Maybe he could give it twice so people could write it down. Thanks.
Sure. It's area code 208-468-3600. And our website is actually www.goldsilvervault.com. Again, goldsilvervault.com, all one word. I think it's in the Twitter profile as well. And again, the number 208-468-3600. It's one of the things that, what I try to do with clients is educate them. So a lot of times, and we are one of the larger private depositories in the country. I mean, I have very good relationships in the industry. It's something that we pride ourselves on the service side, the ability to answer questions, to be able to educate clients, because we get a lot of people that have a lot of money, but the problem they run into is the gold and silver area is a very opaque market. There's not a lot of information out there. There's not a lot of, it's hard to, it's hard to sort of get more information on how do you choose a depository? How do you, what do you buy? What's the best product to own? Or, there's so many questions out there that people have, once they understand the need for physical metal. But and that's where we try to, I have on our media page on our website, just go to media and there's a lot of interviews. Of course, I've done some with Tom, of course, but I've gone through I have some slide decks about how to analyze depositories, what risks to look for. And it's not just so you can apply it to depositories. You can take that and apply that to structured programs, allocated programs, digital programs, pooled programs, unallocated programs. There's things to watch and look for, especially in the storage agreements and the contracts and the user agreements. I mean, these are all things, I try to help people so they don't get into a product or a service that ultimately ends up biting them. And that's, to me, that's important. Especially if you buy metal, you don't want to move it twice. Obviously it increases the chance for error and loss. So by trying to choose the right program wisely, even if it's not through us, at least you have some more tools and more understanding of the industry.
Well, I really appreciate all of the time that you've spent with me, both in private conversation and in on doing interviews and the spaces and everything, Bob. And I really appreciate the education that you've helped spread through the community. I think if nobody has any questions, we'll wrap this up for tonight. We'll give it a minute or two for questions here.
The one thing though that I've looked at, and I'd love to see the industry get more into this, is the idea of working with mines directly and doing offtake agreements where you're able to get ore converted, to at a discount to current spot prices, converted into smaller retail product, and offer that at spot. I think that would be an invaluable service. What you're seeing right now is a lot of there's certainly a lot of profit tiering going on out there in the marketplace. But you're not seeing, even companies that have silver mines that are bringing production into retail product, they're still selling that product as if it's marked up just stuff that's being made by the mints out there. I think there would be a big service out there to try and drive down or add more supply into the marketplace, where it brings those premiums down and allows the public to say, okay, if the COMEX price is this, why, if I can still get metal, whether it's 1 ounce form or 1,000 ounce bars, if I can get it as close to whatever that COMEX price is, or the LBMA published London price, at least then the client can have some stability of knowing that I'm not buying something that all of a sudden I take it off the lot, so to speak, and then it's worth 10 or 15% less just because there's a big spread in the price.
Yeah, and that kind of goes to your earlier point about having a more transparent exchange. And actually, there was one more question, kind of related to that, Bob. And I think there's a couple different points to this question that I think need to be, let's say, explained or understood. Zach's question was Canadians with properties near Sudbury, Ontario. I don't know why that specifically matters. What about a group of investors getting together to buy direct from local mines directly? Many mines, Vale, etc. Silver specifically, or all metals, even buying blocks of zinc or nickel for a commercial business owner with space and trucking.
The mines, it's a neat idea, and Mr. Neumeyer, I don't want to speak for him, but he's been asked a question in the past. What about a company like Tesla or Apple or somebody like that doing a fixed price contract with them? For one thing, if they do that, they give up the right to participate in an increasing market. Okay, so that might handle one part of that. Your little investor club issue in terms or idea or example of somebody in the same town or county or province or something like that getting together, Mines don't sell 0.999 silver. A mine might get together and they might have maybe an 80% silver product. Okay. Get sold.
That was, Jim, that was actually one of the, sorry to interrupt you, but that was actually one of the points that I really wanted to make sure that we hit is a lot of mines just produce a Dory bar.
That's right.
They don't, and there's a lot of work in, let's say, even just creating smaller bars, smaller rough bars, never mind something like First Majestic does, which they do. They create a smaller, I know I've seen their cubes and different things like that.
Sure, that's their retail division. They do have that retail division.
Exactly, but you can't just buy raw metal like that from the mines directly because that's not actually what they produce.
Well, they don't produce 999 silver. So my point was in getting to an answer for you is that let's say that they knocked on the door. They went to the mine and they knocked on the door and they said, "We brought a suitcase of cash. We want silver." Well, they're going to give them the appropriate amount of silver, Tom. But then if that client or that group of clients went to Bob to sell his silver, Bob would say, "I don't have a market for 80% silver." I mean, constitutional silver in America, people call it junk silver, quarters, half dollars, silver dollars. I believe it's 90% silver. So 80 or 75% silver, you wouldn't have a market for that. So that might hopefully help to answer that group of that example that you're asking. They're better off if they would call Bob's company and buy as much as they, could pool their money to buy in 1,000-ounce bars. That's my opinion.
Yeah, I think to kind of explain the point, kind of walk you through the process if this was to work, which is what I've done, and I've talked to like Load and other companies about this. Is you get together, like for example, the fund that I run, we could easily do an offtake agreement with a mine. For example, you would, whether it's financing the mine or basically prepaying or buying inventory or mineable product. But let's just say they pull the ore out of the ground, they smelt it, they get it into a 90% form. We then take it to a well-known refinery that then puts it into 3.9 fine silver 1,000-ounce bars, for example, or they just simply take the ore, melt it down, and give you a credit of, they pay, maybe it costs 1% under spot or 2% under spot to take that Dory bar, melt it down, and that 1 or 2% is the sort of the profit for the refiner. But let's just say you pay 92% or you get 92% metal, and you buy it at that, say, an 8% discount, for example. And by the time you do run all the numbers of trucking and logistics, all that kind of stuff, maybe you walk away and you get metal for, say, 4% under spot, for example. After the discounts and getting that into a creditable form, you then, with that 4% discount, you then go out and buy, say LBMA refined product or mint product, whatever it may be. Even though you're paying maybe above spot for it, you're still using silver that you've received at a discount. Or you just take 1,000-ounce bars that are already in LBMA refined form. Because at the end of the day, the metal that you bring to the market will probably be refined in 1,000-ounce bars, or it could be refined into smaller proprietary product. But you're bringing metal to market at a price that's much more beneficial to the investor. But at the same time, you're able to get fully refined product, at a much more reasonable cost. And if you do that time and time again, what you end up doing is you start to the power away from, or you start adding more liquidity to the system. So it overall brings down premiums across the board. But it is there are companies that do royalties and streaming, all that kind of stuff with regard to financing. But those are more where they're just simply profiting, dollar profits. It's not necessarily to accumulate more metal. This program would be more designed to actually have more metal to be able to offer to the public. And that's, because if you're going to get the public ever to start taking delivery and getting them more involved with precious metals, the market's going to have a much broader reach.
Yeah, that's a great point, Bob. That basically goes back to your same point about having a more transparent market and being able to, in some ways have an actual physical discovery price rather than the futures markets just being seen as the quote unquote spot price when you're never going to be able to buy physical in the real world for that, right?
Right. The problem you have too is the exit strategy. When it comes time to, let's just say silver goes to whatever the number is, and it becomes relatively overvalued, to other assets. Let's just say it goes to a 10-to-1 ratio, gold to silver, whatever it may be. Just like it went to 125-to-1 on one side of the coin, it goes extreme the other side. And let's just say at that point, silver is just priced too high. Then the question is, how do you get out of the product when everyone else is trying to get out at the same time? It's going to be, there'll be a point of a little bit of chaos there, and that's where that's something a lot of people should consider as well. It's just not that we want to sell our silver for dollars and getting devalued dollars for it, but the idea of converting that metal into another asset. I think that's what most people are probably looking at.
Real tight spreads, Bob, in the futures market.
Yes,
silver's a half a cent bid ask all day long.
Yes, and we need to see that. We need to almost have a physical market. I think the American Stock Exchange tried to do this back in the 80s and never took off. But we need to have some type of more nationalized program, that has more visibility, like the COMEX. I mean, the COMEX actually has a kind of great model. It's just that the problem is it's a derivatives program. It's derivatives first. It wasn't really designed as a cash and carry model. It's designed more as a hedging vehicle. But just like we saw last year or in 2020, for example, it became a source of metal because it was the best price in town.
All right, guys, we'll wrap this up for this Friday night.
Thanks again, Tom and Bob. I appreciate it.
Oh, thank you, Jim. Thank you, Tom.
Thank you, Jim. Thanks, Bob. And thanks to all our listeners and all our guests. Really appreciate everybody's time. Bob, of course, really appreciate your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.